City on this Thursday, December 12th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures are in the red this morning after the latest read on producer prices showed headline inflation coming in hotter than expected and initial jobless claims also coming in above expectations. The focus now turns to the Fed as swaps markets price in a rate cut after this week's CPI report came in line with expectations. The European Central Bank, the ECB, they cut interest rates today by a quarter point, setting the stage for the U.S. Central Bank next week.
Plus, on the earnings front, Adobe shares are plunging this morning on its weaker than expected full year forecast. The outlook underscoring anxieties that the creative software giant could be disrupted by emerging AI-based startups. The company has been adding generative AI features to its applications to remain competitive. AI will also be in focus for Broadcom when it reports earnings after the bell today. Investors are looking to its fourth quarter results for confirmation that AI-related growth can outshine some of the weakness in other divisions. We know last quarter, some of that weakness in non-AI units overshadowed that AI growth.
And Meta has donated $1 million to President-elect Donald Trump's inaugural fund as part of an effort to build a positive relationship with the administration after a tense history. While small, the donation is not something Meta did for President Joe Biden or Trump's prior term. Meanwhile, the president-elect was named Times Person of the Year and will celebrate the announcement by ringing the opening bell this morning at the New York Stock Exchange. U.S. stock futures are falling this morning right now after PPI data, producer price index. It came in hot and jobless claims came in above expectations. Then you're taking a look at the Dow futures, the S&P 500, and the Nasdaq, all just barely lower, except for the Nasdaq. That's down by about 0.5% right now, while the Dow is flat just barely to the downside here. And of course, this comes during a week where we've seen some new fresh record highs, of course, notched both intraday and some new record closes as well. The larger question is, what type of fervor will we continue to see from investors going into the final trading weeks of the year here?
Yeah, exactly, Brad. When you take a look at some of those record closing highs, you had the Nasdaq as well as the Nasdaq 100 yesterday closing at that record high. So again, coming off all-time highs there. You have Amazon, Google, Meta, Tesla also at all-time record closing highs yesterday. We talked time and time again how AI is very much responsible or a massive driver of the bull market, of the gains that we have seen at least over the last 2 years. And when you take a look at that outperformance, one of the things that stands out to me, and this is no surprise maybe to people who have been following the movement in the market very, very closely, is the outperformance of Tesla. When you take a look at Tesla's record close yesterday, it was actually the only Mag 7 that hadn't posted a record in 3 years. So again, a significant status, significant milestone there for the company. We know that the stock has certainly surged, to say the least, since Trump did win the election just about a year ago. But again, that stock has surged just about 70% since Trump has won.
We do know that President President-elect Donald Trump is going to be ringing the opening bell. He was selected as Times Person of the Year. Here are some comments live from the New York Stock Exchange.
Incredible group of people. And Jeff, you have done an incredible job, you and your group, and what a beautiful speech you made. Thank you very much. That was some introduction of all of us. But we've gone up since the election. I was just told by Scott, everybody said, you have to pick Scott Bessent. He has to be the one chosen for Treasury. Where is Scott? Let's see. He's around here someplace. He's around here. He told me we picked up $3 trillion since the election day. And I said, well, that's good, but what about before the election day? He said, we picked up some money there because they thought you were going to win. I said, I like this guy. He's going to be my Treasury Secretary. But it's true. I think we're going to have a tremendous run. We have to straighten out some problems, some big problems in the world. When we left, we didn't have any of these problems. We didn't have Russia with Ukraine. We didn't have Israel October 7th. We didn't have the Afghanistan disaster. We didn't have inflation. We had no inflation. and we had a very strong economy. And we're going to do that again, but I think we're going to even up it because now we have experience that we didn't have. Now I know everybody. You know, when I first came in, we came down, Melania and I, a great first lady, who's very popular, by the way. She rang in. She rang in the bell. She rang in the bell. But we came down and we're driving down Pennsylvania Avenue, and it was so beautiful. I said, you know, I've never done this before. I didn't know anybody. I got to the Oval Office, and I'm picking all these big positions, and I didn't really know the people in Washington, but boy, did I get to learn fast. And now we do, and I think we have an incredible staff behind me and others that aren't here. And we're going to do a fantastic job. We're going to create the incentive theory again. In fact, I just announced yesterday, I didn't announce it for this reason, but anybody investing $1 billion or more gets a very expedited approval process because, you know, the approvals, when people come into the country, it takes them, in many cases, 14, 15, 16 years to get the approval. We have Lee is around here someplace. He's in charge of the environment, and that's Lee Zeldin, who ran an incredible race for governor in New York, was a very, very successful guy before that. He was a great congressman, and he's a fantastic lawyer. He's in charge of environmental, and we'll try and push him as much as possible to get those permits very quickly. Like a nuclear power plant, I would say a week would be enough time. What do you think? Is that okay? We're going to get fast approvals, and it's great that we have Lee and all of the people behind. They're all stars in their own way. But it is an honor, and this is a double because usually they don't coordinate the Man of the Year or the Person of the Year with the ringing of the bell. And brilliantly, you picked them both at the same time, and you were all friends, and you said, let's do it. And it takes one trip. It doesn't take two trips. That's okay. We like to save. We like to be able to do it properly. But this is a special group. So many friends in the audience, too. John, great job you've done at ABC. I'm really proud of you, and you've been so nice to me. Otherwise, I wouldn't actually acknowledge you at all. But you have been, that really is, it's a terrific job you've done. But again, I want to thank you. We're going down to ring the bell now, and I could just say that the economy, I believe, is going to be very strong. We do have to solve some problems. We have wars going on that we didn't have. We have a lot of things happening that we didn't have that would have never happened. They would have never happened, but now they have happened. And I want to get them solved. We have to get them solved because ultimately the power of weaponry today is the biggest threat we have, in my opinion. It's not some of the other things that you read about. It's the power of weaponry. The weapons are so powerful, so devastating. And I rebuilt our military. I got to know every one of them, including nuclear weapons. I hated to do it. Actually, I hated to do it. But we did some nuclear weapons that are so devastating. It almost makes you very sad as you get them and as they come online. It makes you very sad because you know what the purpose of them is, and you just hope to God that you never have to use them. Because if you do, the world will never be the same. So we have to be very, very smart. We have to be very sharp. We have to be very special to do a job. And I think we'll get it done. And I think we're going to get a lot of people in the room. We've seen it. We were in France where President Macron did a fantastic job with the cathedral, an absolutely fantastic job of Notre Dame. And it was beautiful. The opening was the opening, and I just got back, and it was something really beautiful. And a lot of world leaders there. We had about 80 world leaders, different countries, and they were all coming together. They all wanted to meet us and meet me as representative of the U.S., and there was a lot of goodwill. But we're going to get some really tremendous goodwill. I was even thinking about inviting certain people to the inauguration, and some people said, wow, that's a little risky, isn't it? And I said, maybe it is. We'll see. We'll see what happens. But we like to take little chances, but that's not a bad chance. Here's a gentleman that's going to do a great job at HUD. Good luck, my friend, right? He's going to be a star. He's been my friend for a long time. It's nice to see you. I haven't shaken his hand yet. Come on. Congratulations. Thanks. Really, you're going to be great. And Ben Carson is your biggest fan in the world. You know that. Ben has been with us for a long time and has done a fantastic job. Thank you. Good. So, ladies and gentlemen, go on. We're going to put it straight. We're going to give tremendous incentive like no other country has. We're cutting your taxes. We're going to cut them very substantially. We got them down to 21% from probably 42 or 44%, depending on where you are. And we got them down to 21. Everyone said that was a miracle. Now we're getting them down to 15, but only if you make your product here. Otherwise, you pay 21, which is not bad. It's in the middle of the pack. But 15 brings you down to among the lower. And for those that are running the big companies, those great, big, beautiful companies, nobody's going to be leaving us. You're going to be coming back. You're going to be bringing it back to the United States. We are incentivizing everybody to come back to the United States. We want you back here. Car manufacturers, everybody. And we have one product that nobody has really to the extent that we do. It's called oil and gas. There is no country in the world that has more. We're number one. I brought it to number one during my first term in terms of production. We're going to be number one plus. We'll do numbers that nobody will really see before. And when that happens, prices are going to start coming down because people can't afford their groceries, and they're going to be affording their groceries very soon. I tell the story about a woman who, an old woman, no money, went to a grocery store, had 3 apples. She put them down on the counter, and she looked, and she saw the price, and she said, "Would you excuse me?" And she walked one of the apples back to the refrigerator and came back to pay for the 2 apples. And she left with 2 apples. And the woman at the counter said that was so sad. And when I heard about the story, I said, that should never happen in America. And it's not going to happen in America. We're going to do it right. And we're going to take care of our people. And we're going to do things that nobody ever thought even were possible. But we're going to have an economy the likes of which nobody's ever seen before, and everybody's coming back to America. I saw that the other day at the cathedral. They're all saying, we want to come back, we want to come back. And with a couple of changes done by Howard and Scott and some of the great people up here with me, we're going to bring them all back. They're all coming back. So thank you very much. This is a great honor, and ringing the bell will be fantastic. And go out and get them. We're with you all the way. Thank you very much. Thank you.
As President-elect Donald Trump making some comments at the New York Stock Exchange. Now he's headed down to the floor where he's expected to be ringing the opening bell on Wall Street in just about 18 minutes. We saw President-elect Trump up there speaking with Melania. You can see right beside him. He also had Scott Bessent, his pick for Treasury Secretary, alongside him, as well as RFK Jr., a long list of some of those within his administration up there with him to celebrate here today. And also President-elect Donald Trump being named Time Person of the Year. He also made some interesting commentary just in regards to the market. He talked a little bit about inflation there, just some of the pressure that consumers have been under. He mentioned tariffs. He mentioned the fact that just in terms of what he views as the biggest threat here, or the biggest, or he's saying that the power of weaponry today is the biggest challenge, to put it in his words here, not only facing the U.S., but on a global scale as well. But again, we talk about the significance here of President-elect Donald Trump down at the New York Stock Exchange, and we know, to no surprise, he very much monitors and likes to brag about some of the outperformance that he did see in the market during his first term, and very much, I think, monitors and closely tracks the outperformance or the performance of the market, and maybe ultimately how he interprets that as some of the success of his economic policies.
Yeah, something that he posts a lot on, well, now Truth Social, but previously in the first Trump term, posting about it on Twitter. Every time there was a new all-time high, there was probably a Trump tweet tied to it. At the same time, the set of circumstances that he was acknowledging are vastly different in this go-round. And so when we come to Inauguration Day and when he does get into the White House once again, there's going to be a different set of obstacles that really need to be navigated, geopolitical tensions. And he talked about and alluded to some of the dangerous weaponry and hoping that we don't have to use that. Of course, anything that would issue into the discussion that weaponry could be used would naturally ratchet up the geopolitical tensions, and the markets would be interesting to see, of course, how the markets price that in as well. Additionally, on the inflationary front, he mentioned what it was and said it was at 0 during his previous term. When he left, it was actually averaging at about 1.2%. But again, compared to now, vastly different. And then also going forward, it's going to be the corporate relationships that he was talking about too. Which of the companies that he's doing business or that he's hoping to bring back to the U.S. are going to be appeased teased by some of the corporate taxes as well. He said that they're going to bring that down to 15%. That will be something that certainly has perked up the attention of a lot of corporate executives out there right now, too.
Yeah, he also went on to say that we have to solve economic problems, and we know the plans for deregulation, also some of those tax cuts. You mentioned the corporate taxes, getting those down to 15% has certainly been a huge driver of some of the outperformance and record highs that we have seen in the market over the last month and a half. But let's continue this discussion. We want to bring in our first guest here. We have Paul Meeks. He's the Chief Investment Officer at Harvest Portfolio Management and partner at Wall Street Beats here. Paul, it's great to have you. Let's start on some of the comments that we just got from President-elect Donald Trump, what he plans to do in terms of deregulation. You talked about the fact that he wants to bring the corporate tax rate down to 15%. As a close insider and someone who closely tracks the tech industry, here we are with tech at record highs. How much more momentum could this potentially add to that trade?
Well, the first thing I'll say, because I was listening carefully to his comments a moment ago on your program, and even though there has been chatter about the corporate tax rate going from 21 to 15%, ever since Scott Bessent has been named as U.S. Treasury Secretary, he's really avoided that question and focused on other aspects of fiscal stimulus. And so today, for Trump to say that, and of course there's a caveat where you must manufacture your products in the States, that is actually a confirmation, if we actually carry through once Trump is sitting in the chair in late next month, that there could be another nice win. Because I've always been a bit skeptical if that was campaign rhetoric or if that was real, but he doubled down on it today. And let's see if Scott Bessent, when he is alone talking on the networks, sings the same chorus. But that was the takeaway I had today. As far as the market going forward, we've probably taken a little bit of next year's run in stocks and pulled it forward, with Trump being one of the key factors for that. But I still think if we were to talk a year from today, right, we're wrapping up 2025, I imagine that the tech sector again outperforms the overall S&P 500, and that the S&P 500 doesn't have such a big gain as it's had. It's been over 20% each of the last 2 years. And we all know over about the last 100 years of the financial republic, stocks do about 10% per annum. But I still think it's reason to be constructive. And so I am very careful with my tech picks because some of them have run. So my fresh money buy list has shrunk somewhat. But in those names, I'm still bullish.
What's on your fresh money buy list? If we did see indeed a pull forward in some of the market activity or performance to the upside, and that would potentially hold in your view that we could see some type of pullback. If we did see a pullback or even a correction next year, what are the top names that are at the top of your list right now?
Well, everybody asks me about the Mag 7 continuously, and I will tell you that I'm refined with my thinking there. Of the Mag 7, the only ones I really support for growth and valuation at this level are Amazon, which I think will see a nice upside surprise when they report, and also NVIDIA. And I know that NVIDIA is working on a triple this year, and the stock tripled last year. However, their growth and their growth prospects have eclipsed that. So those are my two favorite names among the mega caps. I am going to, at least in the early part of 2025, stick with my AI infrastructure building plays. Those are primarily semiconductor companies like the aforementioned NVIDIA. I'm also starting to warm up to advanced micro devices because it's come down a lot. I like Broadcom, which will be reporting tonight. And I also like Marvell and Taiwan Semi. I am not sold, and this is reflected in Adobe's atrocious run this morning, that the AI software companies, the beneficiaries of the AI infrastructure build, will see the goodies so soon in 25. And also, even if they have AI use cases, they're not showing yet. And I need to see some evidence that they're monetizing that business.
All right,
so that's how I take a look at the sector. and the plays within the sector as we roll from 2024 into 2025.
Certainly. A lot to continue to track with Adobe here on the day after the company just reported earnings as well here. Paul, thanks so much for taking the time here with us this morning. Appreciate it.
Best wishes.
President-elect Trump has been named as Time's Person of the Year, coinciding with the announcement the incoming president going to be ringing the opening bell on Wall Street. Let's go down outside of the New York Stock Exchange. Our own Jared Blickery is set up and positioned. Jared, I see you with the famed New York Stock Exchange Christmas tree and menorah behind you as well. What are you seeing? What's the vibe down there?
Yes. The vibe, there's some excitement here, relatively quiet. I think this was under wraps for security reasons, but nevertheless, there's a lot of excitement. It's not every day that you have a president, much less a president-elect, coming down here to the very heart of the capital markets to ring the opening bell. And interesting because Donald Trump really hung his hat on his presidency, his first term, on the stock market. And we recently had Bruce Willis, he's a chief economist over at RSM, in our studios, and he was saying that while the stock market was a barometer of the first Trump presidency, it's likely to be the bond market that really reins in or governs the second. And that really has to do with the long-term fiscal trajectory of the United States. Trump is inheriting a very high current account deficit that he has to face, that he has to get down, whittle down. And amid that, we see a stronger dollar. And the dollar is another thing I think we're going to have to watch in this Trump presidency. We've seen a huge market reaction so far on the deregulation front. Financials are excited. Industrials are excited about the infrastructure plays. And we also have reforms in immigration and potentially deportation that could add to inflationary pressures. So you throw tariffs on top of that, and we've got a really interesting mix, and we're going to see how this all shakes out. But again, we're going to be watching the dollar and the bond market for the second Trump presidency, guys.
Certainly will. All right, Jared, we will be checking in with you in just a few minutes. Once again, as we do head to break, let's take a look at the live shot that we do have of the floor of the New York Stock Exchange. President-elect Donald Trump set to ring the opening bell just about 8 minutes from now after being named a Time Person of the Year. We're going to bring that to you when we come back.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we're tracking shares of Meta. They've donated $1 million to President-elect Donald Trump's inaugural fund. This comes as CEO Mark Zuckerberg looks to strengthen his relationship with the incoming president. Zuckerberg attended dinner with Trump at Mar-a-Lago in November following his election win. Musk and Meta's Zuckerberg, everyone has been trying to make sure that they at least stay in the good graces of the president-elect at this juncture right now.
Yeah, Zuckerberg, one of a long list or a list of tech executives who are trying to rebuild a past strained relationship here with President-elect Donald Trump. When it comes to some of the past tension between the two, we know the suspension of Trump's social media accounts following the January 6th riot there on the U.S. Capitol. That, of course, invokes some commentary there from President-elect Donald Trump, who has very much said that Zuckerberg has been unfair in the past. We know that Zuckerberg has been trying to rebuild that relationship now for quite some time over the last several months since President-elect Donald Trump did begin the run here for the White House. So again, this is significant just in terms of the fact of what this ultimately will do or what this ultimately could mean for the relationship going forward. Obviously, Zuckerberg doing everything he can to get Meta in good graces here with the incoming administration.
Yeah, huge implications as well, especially considering that Meta has its own host of social media platforms that it also will foreseeably have to make sure that it continues and will continue to compete and perhaps still hold the lion's share of advertising dollars versus a Truth Social right now.
Let's take a look at Microsoft is planning to take an $800 million charge after GM, General Motors, announced that it was shutting down its robo-taxi business, Cruise. Microsoft announcing a minority investment in Cruise back in January of 2021. That was part of a $2 billion investment round in the startup. You're looking at shares of Microsoft off just about 0.4%. The move had at the time at least given Microsoft that stake in what had been a nascent market when it comes to the connected car services business. There was lots of promise maybe ultimately about what this would do for the business here in the long term. So again, when you take a look at the fact that it is planning to take that $800 million charge here after GM said it was shutting down that part of its business, obviously a bit of a concern here for investors.
Yeah, shares down right now by about 0.4%. I mean, of course, Microsoft have been trying to get ahead of the game too with some of those strategic investments, making sure that within any type of autonomous vehicle future that they did have some exposure. Of course, Google, they had their own internal other bets division with Waymo as their kind of shining star there. So Microsoft making sure that they had some exposure here, but with General Motors changeover, certainly that impacts the value of that investment that Microsoft has made, and that is the reason for this hit and this $800 million charge. Coming up, everyone, Trump is going to be ringing the opening bell on Wall Street. There you see him up on the podium. Stay tuned. You're watching Morning Brief. Just seconds away from the opening bell, clapping and cheering happening at the New York Stock Exchange, where Times Person of the Year has been named. It is President-elect Donald Trump, and he's ringing the opening bell on Wall Street there, joined by his wife, Melania Trump. You're also seeing Vice President-elect J.D. Vance ringing the bell and up on the podium, as well as, I believe, Jeffrey Sprecher, who is the CEO of the Intercontinental Exchange, the parent company of the New York Stock Exchange, up on the podium as well. Jessica Sibley, CEO of Time, also ringing the opening bell. This is an annual occurrence for Time. Typically, the Person of the Year joins them to ring the opening bell. We're seeing that here today. Last year, Taylor Swift could not join. This year, President-elect Trump making his first appearance ringing the opening bell at the New York Stock Exchange.
Yeah, we talk about the significance of this, obviously being named Time Person of the Year, but just going beyond that and how much focus President-elect Donald Trump has placed on the performance of the stock market, especially during his first administration. When you take a look at that past performance index, getting just about 61%, the S&P up until this stage of his first presidency, when you compare it to the performance here of current President Joe Biden. And also when you take a look at the outperformance, I think more notably that we have seen since the election of Trump just about a month and a half ago, we have seen broad outperformance, record high after record high here from the market, a bit optimistic about some of the deregulation efforts that are expected to come under President-elect Donald Trump. Also, some of that excitement surrounding tax cuts. He just made a commentary earlier on this hour talking about the corporate tax rate, his plan to lower the corporate tax rate to 15%. That has really been a focal point of so many strategists that we have talked to here and business leaders that we have talked to over the last couple of months, but especially over the last several weeks, just in terms of setting up here for that 2025 trade. Let's get down to Yahoo Finance's Jared Blicker. He's standing outside of the New York Stock Exchange. Jared.
Thank you, Shauna. We're seeing stocks open a little bit to the downside here for the most part, but we are sitting at record highs for the Nasdaq, if not very near, and for the S&P 500. We've also seen small caps come roaring back since the President Trump won the election, and it's been really interesting and fascinating to see which sectors are responding to the news that we will have a lighter touch in regulatory matters, that we will have abroad a different strategy with respect towards China. China has become roaring back recently after suffering an initial pullback, but they're coming out with incredible stimulus measures, and the whole world, I think, is waiting with bated breath to see what President Trump brings to the capital markets once again. And we are standing right here at the nexus of the capital markets. This is a New York Stock Exchange, and as I was just referring to minutes ago, a bit unusual to have a president, much less a president-elect, who's coming here to ring the opening bell, but really not that unusual when you consider that this is Trump's home and also his celebrity status. We do see a lot of celebrities come down here in addition to all the CEOs. But for the markets today, we're kind of lulling or falling into a holiday cadence here, and we're expecting maybe that Santa Claus rally to come at the end of the year. But it has been an historic year already. This is the second year in a row that the S&P 500 has cleared 25%. And so the expectations for next year are even higher. Third year of a bull market tends to be not as strong as the first two, but anything can happen. We have a number of catalysts on the horizon. And with that, I'm going to send it back to you guys.
Thanks so much. Appreciate it. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at the stock market under President-elect Trump.
That's right. I want to take a look at the market performance under Trump 1.0 in the context of him ringing that opening bell on the New York Stock Exchange this morning. Just to give some color on that, some sources down at the exchange this morning sending me pictures of the individuals who are there, the likes of Bill Ackman and Jane Fraser, for example. We also saw Scott Bessent, the pick for Treasury Secretary, right behind him, really indicating this idea of a markets forward administration to come. He talked about Bessent's $3 trillion mention of the market cap that was added to the S&P following the election. So that'll be interesting in contrast to what I'm about to talk to you about here. This is Trump's performance as rated by the S&P 500 in his first term in office. You can see this here is what I really want to zero in. And from 2018 to 2019, we saw a lot of volatility in the market due to the questions about the trade war. This was under Trump's first round of tariffs that he wanted to implement. There were a lot of questions on Wall Street just about what the implementation of those tariffs would look like. It took about a year to get some of that clarity. Brian Levitt from Invesco this morning telling us that, yes, we did see those questions for about a year, but eventually you did see Trump kind of getting in line with what the market performance was telling him, which is that they needed clarity on that trade war. And then, of course, you saw the big rally heading into 2020, which is why we saw an overall very positive performance under the first administration for Donald Trump. Now, what's interesting, too, to point out from Brian Levitt this morning, also adding that if you do see any kinds of corrections like this under Trump 2.0, he sees that as a buying opportunity. So I think that's interesting as well in the context of the fact that this morning we did not hear Trump mention tariffs at all at the New York Stock Exchange. Yes, we know that is part of the kind of front that he is planning to focus on with policy moving forward, but he did have individuals behind him who we know think of tariffs as more of a negotiating tool as opposed to something that they want to be implementing strongly on day one. So that's just something to think about as we head into Trump 2.0 in the context of the tariff market impact under the first term, guys.
All right, Maddie, thanks so much. We're going to get to our strategy session for today and what can investors expect and how the markets could potentially perform under President-elect Trump the second time around. We want to bring in our next guest, Gaurav Malik. He is Apollo Capital Advisors Chief Investment Officer. It's great to have you here. So how should investors be thinking about the setup as we look into 2025? We have certainly gotten so many market outlooks here over the last several weeks, and it seems like the resounding consensus is a bullish setup heading into the new year. I guess more specifically, what do you think that is going to look like?
So I think the question is for us, certainly as we look at the next year, what has already gotten priced in, right? So there is a lot of bullishness that came out soon after the results came out of the election. The fact that the Republicans are going to control all the three houses, the two houses and the White House. Now it's a lot about what the actual earnings are going to look like for firms. I think that has not changed. Unless we see a follow through of these elevated valuations by a really corresponding increase in earnings, I think this rally can sort of pause. Our perspective, looking at the last administration, we do think one area to focus in on is capex. Capex is a really nice theme. We think it's an enduring theme for a few years, and we're looking to play that in every possible way. In public markets and private markets, private credit, infrastructure, everywhere we can. The combined effect of both the Biden administration's spending on CHIPS Act, IRA, that's likely to continue for several years, plus the move the Trump administration is looking to make with regards to deregulation, potentially bringing down corporate taxation, all that plays really heavily into this capex theme. So I think that's where we feel most comfortable about. Today, at a very high level, looking at the S&P at whatever 22, 23 multiple, it needs to have earnings that build into that multiple. The current expectation for next year is about 30% consensus. We're somewhere a little bit lower than that. We think maybe it's 11 or 12%. The market is pricing in closer to 20, 23%. I think that's the part that you've got to put some emphasis around. We do see generally a broadening of the rally. So we do think some of the sectors you were talking about, small caps, financials, could grow and show some nice earnings. But it's really a lot about earnings as we look at really what is it that's going to drive the actual, can the earnings grow into the valuation that we're seeing today?
Certainly. A lot to unpack there. I want to focus in on the capex component that you were mentioning, because how do you suspect that investors will grade the type of capex and the scrutiny, I guess, in some of the spending or intention of the capital expenditures that companies are announcing and putting forward, and how and on what time frame should they expect real gains to be actually priced in to the valuation and put into the valuation based on kind of the realized financial performance?
Yeah, so I think that number one, like if you think about strategic sectors, like chips is the one to think about for a second, right? There's a lot that's been done, a lot of plants and a lot of things being put up. We have to see what the execution is going to look like on that front, but we feel pretty comfortable and confident that there's going to be some moves in that area. We're very comfortable and confident that the AI theme is going to continue. So again, data centers, the energy needs, which are massive by any stretch of the imagination. The amount that's already been allocated by the Congress towards infrastructure, but has actually not been used. So industrial sectors, defense, I think that's going to be an area where not only the Trump administration, but I think on a global basis, you're going to see a lot more expenditure occurring in that area. So those are the sectors to look at, the industrial sector, the construction sector, the defense sector. Those are the places we're going to see some chance to play into that. On the private side, I think still there's a lot to be done with roads and bridges, renewables on the energy side. Those are the real nice things to play on the private side.
Gaurav, thanks so much for taking the time here with us just after the opening bell. Appreciate it.
Thank you.
Coming up, everyone, a bullish call for airline stocks in 2025 as the industry boosts travel demand forecasts. Southwest CEO Bob Jordan joins us next in studio. You're watching The Morning Brief.
Airline stocks set to climb in 2025. Morgan Stanley making a bullish call on the sector, predicting that a, quote, perfect storm of tailwinds will boost profitability. Joining us now, we want to bring in Bob Jordan. He's the CEO of Southwest. And Bob, it's great to have you back here on Yahoo Finance. Thanks so much for making the time to join us at the desk.
I appreciate it.
So we have a lot to get into. And I had the chance to be at Goldman Sachs' Materials and Industrials Conference last week. And you upped your guidance, lots of positive commentary just on some of the demand trends that you were seeing within the industry. I guess my question to you is, when you take a look at the fact that you did raise that guidance, how much of that is demand driven versus operational efficiencies that you're seeing?
Well, first thing, I'm really excited. We announced a huge transformational plan in September. Everything from the new extra leg room, premium, to Getaways by Southwest Airlines, a new partnerships that are going to be able to take you around the world. But a lot of what's going on right now is working on the tactical side of the business. So revenue management techniques, adapting our network. You saw that we're making some changes. We're actually shrinking O'Hare and Atlanta, investing in Nashville, investing in Austin. And it's really a lot of that. So those tactical investments are really taking hold. And yeah, the backdrop is really constructive, and I'm sure we can talk about that, but it's the actions that we're taking that really boosted the guidance.
How much more price do you think you can push into the environment right now, especially as there is this focus on premium customers?
Well, as you know, airfares are, on a relative basis, far cheaper than they were 20, 30 years ago, but there have been increases. We're really focused on two things: adapting the network and adding new distribution techniques. Meta search. We've never been on Google Flights as an example. We added Kayak. We added Skyscanner. We're now making changes to adapt to selling on TikTok as an example.
Interesting.
And so all of that will help boost load factors. So just add more folks into the aircraft. We have room to do that. And then the revenue management changes and the extra legroom are really about boosting the yields, so boosting price. But at Southwest, it's more about giving you something more for that fare. So giving you a premium seat, giving you extra legroom. But I think there's room to continue to boost the yields. The backdrop is really constructive. As you know, Boeing has challenges. And we were supposed to get 80, 85 aircraft this year. We'll get 20. And next year looks to be more, but we still have constraints.
What have those conversations been like with Boeing? And I just from the conversations I'm sure you've had with Ortberg since you did take over, just how confident you are just in that turnaround plan really taking hold soon?
Well, I know Kelly. Kelly's the right person for the right job, but it's very complex. There's a lot to work on in aircraft, in defense, and in services. But what I love is that Kelly's on to the right things. He's talking about the culture of the company. He's an engineer and working hard to get the manufacturing back in place. So they will make progress, but I do believe it's a multi-year effort. And on the other side of the constraints, the Airbus, the geared turbofan Pratt engine work that's going on right now, that's also a multi-year effort to fix. So I think the constructive backdrop for the industry is in play for 4, 5, 6 years, which is it's a good thing. We've also done our part. So capacity at Southwest Airlines is down here in the fourth quarter 4%. It'll be down 1 to 3 in the first. And we're going to constrain our capacity in the 1 to 2% for 2025, 2026, 2027. And the best of all with Southwest is all of that capacity is being created with initiatives. So we're compressing our turn times. We're adding new red-eye flying. And all of that is flying that comes on without having to buy extra aircraft to fund the flying.
When you talk about capacity restraints here, or constricting that, does that mean that you're going to be sunsetting specific routes that you're running right now?
Well, you're always adapting the network, and a lot of this is just adapting to consumer demand. Coming out of the pandemic, demand is much more variable. Business is still not fully recovered, so days of the week, the highs and the lows between days of the week and the highs and the lows between the time of the day are just a lot different than they were before. So you do that. And then we're always adapting routes. We closed a few cities. They just weren't working, and we hate to do that. But we're taking that capacity and putting it into places where there's real demand for travel, especially for Southwest, the Nashvilles, the Austin, the Orlandos, the Las Vegas. But you're always moving capacity around, and we're committed to continue to do that.
Well, let's talk a little bit more about the macro backdrop. And we had President-elect Donald Trump ringing the opening bell this morning. When you talk about deregulation efforts, talk about the fact that we're expecting tax cuts. He made the comment this morning he wants to lower the corporate tax rate down to 15%. What does that mean for Southwest?
Well, we work well with every administration, and but obviously there's a lot of thought going in right now into what the change means. I think it's constructive in a lot of ways. There'll be obviously tax efforts that I think are constructive. The regulatory environment, I hope is also more constructive for the industry. But at the end of the day, our priorities as Southwest and in industry are still the same. It is really get the ATC system fully staffed. We need more and more controllers, and then work on modernizing the FAA. Mike Whitaker, as the administrator, has done a great job. We just need to continue that progress. And then the other one is at airports. Airport infrastructure is aging. So the bag systems, you check your bag, put it on the belt, and it disappears. Well, behind the scenes, all of that screening for the bag, that equipment is 10 and 20 and sometimes 25 years old, and it needs to be focused on as well at the TSA.
When you think about the Department of Government Efficiency that's been talked about, where would you like to make sure that there isn't the removal of, or the additive of, looking at TSA, looking at the FAA, and saying this is where we need to be more efficient and making massive cuts there, versus what you're saying in that we need more roles in those positions?
Well, I was in DC last week,
yeah,
and had a chance to obviously talk about our priorities as Southwest and as an industry. The Vivek Elon effort, the Doge effort, I think is real. And you've got companies lobbying for priorities to that group as well as lobbying for priorities to the administration. I don't think that the effort is simply cut and cut and cut. It's be more efficient. We can do more with the money that's invested in the government. You take the FAA, and we've worked on modernization of the technology for decades, and the technology in some cases dates back to the 1960s. So that's a lot more about being efficient in the system. We can fly a lot more aircraft through the ATC system if we have better technology, and I think that's what the Doge Group is after.
Well, we just had news this morning that FAA Director Michael Whitaker, he will be stepping down. He sent that press release or release here email to his staffers earlier on today. This comes when we take a look at the Trump administration then taking over. I guess, what do you think is critical to have in the next leader of the FAA,
well,
just given some of the success?
Well, Mike has done a great job. I know Mike well, and he has really set the priorities. And I'd love for Mike to stay, but I think that what's really critical is to continue the progress and make even more progress. We need a terrific leader. Mike's done that. He's very organized. But we need to continue to invest in the air traffic control system, and we need to continue to invest in technology, and we need to get the controllers staffed. Those are the real priorities.
Bob, thanks so much for taking the time.
Thanks for having me.
Can't wait to check back in the future as well here. We got to get down there to Southwest HQ.
You're welcome anytime.
Yeah.
We would host you anytime you want to come.
Thanks so much, Bob.
Thank y'all.
Southwest CEO Bob Jordan joining us here in studio. Coming up, everyone, we're recapping 3 stocks in 60 seconds each. We've got more when Morning Brief returns. We're taking a closer look at some trending tickers this morning. Let's go. First up, we got to take a look at GE Vernova. They laid out some 2028 targets, including about $45 billion in revenue, plus high single-digit organic revenue growth. Some analysts view the targets as conservative, with room for more growth. Yahoo Finance spoke with the CEO, Scott Stresik, on Wednesday, and he touted increasing demand over the next decade.
A lot more demand will happen in the U.S. throughout the rest of the decade. And then that install base is going to continue to run. I mean, you think about the U.S., and between 40 and 45% of our electricity comes from gas power today, and we're about to go into a real load cycle. In the rest of the world, that number is closer to 25%. But as other parts of the world shift, like the U.S. has shifted with things like coal to gas, the proportion of gas electricity will only grow.
Plus, we're taking a look at Adobe giving a weaker than expected full year outlook. Revenue and profit expectations missing the mark, fueling some concerns about the company's ability to compete with AI firms. Adobe's fourth quarter results were mostly positive, but the outlook is weighing on shares just a bit. And that was a real focus on the street here this morning. Evercore out with a note saying that it was a solid quarter that was immediately lost in a guidance that seems to be reasonable, but offers no real indication when it comes to Firefly and Adobe's generative AI products that are starting to positively inflect. And that's the real issue that we're seeing with the stock here this morning.
And finally here, TD Cowen feeling bullish on Uber after a meeting with the company's CFO. Analyst John Blackledge, who has a buy rating on the stock, highlighting a number of growth drivers, including the rideshare's mobility business, UberX, Uber for Teens, and Uber XL here.
Another ticker that we're watching today is Service Titan, ticker TTAN. It's set to start trading on the Nasdaq today. The cloud software provider pricing its IPO above the expected range at $71 a share. That values the company at about $6 billion. We talk about the fact that we are expecting to see an uptick in IPO activity going forward, more so looking ahead to 2025. But again, the fact that this did price here at the high end, this does give it a valuation of just over $6 billion. Will be interesting to see what the market's reception to this opening trade is going to be here today, Brad.
Yeah, for the 12 months ended July 31st, 2024, the company had $685 million in revenue, 24% year-over-year growth, this via their S1 filing, and then additionally gross transaction volume that was sitting at about $62 billion for that same period as well. So we'll see how the street receives them. And of course, now we're going to get some more quarterly and cadenced figures from the company as well here.
Yeah, again, the shares pricing at $71 a share. The previously indicated range was between 65 and 67. All right, well, that does it for Morning Brief. But join me and my co-host Madison Mills. We've got you for the next hour. More analysis coming up on Catalysts. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's take a look at the three catalysts that we're watching this hour.
First up, President-elect Trump ringing the opening bell on Wall Street. What can we expect from markets when he takes the White House? We'll discuss.
Plus, PPI data and CPI coming in above estimates. What does it mean for the Fed and its rate path?
And crypto ETFs, now the largest holders of Bitcoin. What the flows tell us about where the growth opportunities are for crypto investors in 2025.
U.S. stocks on the move this morning following the PPI and jobless data this morning. It was a big morning on Wall Street as President-elect Trump rang the opening bell at the New York Stock Exchange. Now, markets have cheered the incoming president since the election results. Today, he made some comments about corporate tax rates. Let's take a listen.
We're cutting your taxes. We're going to cut them very substantially. We got them down to 21% from probably 42 or 44%, depending on where you are, and we got them down to 21. Everyone said that was a miracle. Now we're getting them down to 15, but only if you make your product here. Otherwise, you pay 21, which is not bad. It's in the middle of the pack, but 15 brings you down to among the lower.
Market momentum here following the election of President Trump has continued, bringing the market to 57 all-time highs. And Maddie, when you take into account some of the commentary that we got from President-elect Trump this morning, to no surprise, he loves bragging about the economy, loves bragging about past market performance during his first term. He very much was promoting his incoming administration. Many of those members were lined up behind him. Of those, Scott Bessent, his Treasury Secretary pick, was one of the members of the incoming administration who accompanied Trump to the floor of the New York Stock Exchange today. But we can talk about some of that excitement that has played out in a number of strategists over the last several weeks who have touted some of the excitement, or I guess pointed to some of the excitement when it comes to deregulation, when it comes to tax cuts, very much mirrored in some of the commentary that we got from Trump this morning.
I think it's two big things this morning, not only the commentary, but also the figures who are surrounding Trump at the stock exchange. We know Jay Wood sending me a picture of Bill Ackman on the floor this morning. Citi's Jane Fraser is there, also reporting of Solomon, Howard Lutnick being there. So a sea of figures around Wall Street coming to the stock exchange this morning, presenting kind of a united front in this idea of the market getting on board with Trump 2.0. And he actually talked about this in his speech, the idea that the market and the media are being more friendly to him this time around. He was happy about that. A couple things on the policy front that you pointed out, Shauna, that also stood out to me. He made this joke about nuclear and the idea that power plants should be approved within a week. I think that was a small comment, but an example of just the degree of movement that he can cause with one single comment to these individual sectors. He also obviously talked about those tax cuts. He talked about a crypto-friendly administration to come. He didn't mention tariffs, and that is so critical to the market because this is something that's been a headwind that investors have been concerned about moving forward. He's got Bessent over his shoulder, who we know sees tariffs as a negotiating tactic and not a policy he wants to take to full fruition here.
Yeah, he did, though, mention, I guess, inflation. And I'm just tying that to tariffs because when we talked to so many of the economists in the past, just there has been some concern about what tariffs would ultimately do to inflation, whether or not it would, we could potentially see a reacceleration in inflation if tariffs were imposed. He didn't mention tariffs specifically, but he did just reiterated the fact that he was confident that inflation was going to continue to come down under his incoming administration, talking about the pressure that so many Americans still feel on a daily basis. But you're right to point out the lineup of who was there, not only his incoming administration, but when it comes to the business leaders and who exactly was accompanying him on the floor, I think just speaks volumes and also just speaks to some of that strength that we've seen in the market here over the last 5 or 6 weeks since we did get those election results. We want to bring in Kevin Gordon. He is with Charles Schwab to talk a little bit more about the outlook, looking ahead for the markets in 2025. And Kevin, it's great to have you here.
Morning. Nice
on set. So you just recently published your 2025 outlook, and one of the big drivers, or one of the big factors, I should say, within that outlook was the incoming Trump administration and the policies there. How do you see that driving markets in the new year?
Yeah, so it's tough because, I mean, as you guys were mentioning, there's a pro-growth side of this, there's an anti-growth side of this. Pro-growth, you think about less stringent regulation, possibly, either an extension of the TCJA from 2017 or further corporate tax cuts from there. On the anti-growth side, you have everything from tariffs to more restrictive and aggressive immigration policy. So potentially they offset each other, but I think that the sequencing is pretty important here. And the discussion about taxes this morning in particular, it's really not something that can be tackled, number one, unilaterally, but number two, until sort of well into maybe 2026, because you have to wait until the end of 25 for the expiration, and then you have to go through, the entire sort of negotiation process between the White House and between the rest of Capitol Hill. So that aside, I think based on some of the policy posts we've gotten from Trump over the past couple of weeks, especially as it pertains to Mexico and Canada, probably seems that he wants to start tackling tariffs and immigration right away. So from our perspective, at least from a market volatility sense, that's probably more of the driver, and is probably why you can never compare two eras and say that they're going to be identical, but it's probably a reason that you can use 2018 to some extent as a playbook from a volatility standpoint. There was a significant amount of volatility that year, not as much in the first part of the year, because that 10% correction we had was more driven by the shortfall implosion, but probably what you started to see in the second half of the year, where you did have, at that time, a near bear market. Not to say we get the exact same thing this time, but when you look at the sector makeup and what was hit the most with cyclicals, bearing the brunt of that, that's probably more of a realistic scenario to at least get more familiar with, because this year has been, pretty great, at least at the index level.
Heading into that potential correction off the back of this policy, should investors be thinking about buying opportunities in any of those pullbacks?
Well, I think that from a breadth standpoint, we're at right now, even though we've seen a little bit of a weakening over the past couple of weeks where, it's kind of back to that Mag 7 trade at the expense of the rest of the market, underlying breadth and overall breadth for the market has been relatively strong. So if you were using at least a year out time horizon and looking at the market and what returns tend to look like when you've got this solid of participation and this solid of breadth for not just the S&P, but now moving down the cap spectrum, it does bode well looking at least a year out. So it would argue, to answer your question, probably yes. However, if you continue to see the market make new all-time highs and get to these records while breadth was deteriorating, it would probably bring back a scenario that we saw in late 2021 where you did start to see that divergence, and of course we know that ended up leading to a bear market. So I think we're far from that at this point, but if that were to start to sort of be the picture that you saw heading into 25, especially with a lot more policy risk, not just from a tariff perspective, but I would argue maybe more importantly from an immigration and a labor policy perspective, then that would be a bit of a different story.
What do you expect? I guess, what is your assessment there? Just in terms when it comes to the labor market, when it comes to the promise here from the incoming Trump administration of mass deportations, lots of questions about what that ultimately is going to do and some of the underlying weakness, maybe that will then be exposed in the labor market. How big of a risk is that?
Well, a lot of this is hard to tell. From a timing standpoint, it's not as if you can carry out, I think logistically, this is sort of a nightmare in terms of trying to get that many people out of the country if you were to go more towards the aggressive end of what he's been proposing. If you were to just do the math of taking those individuals out and look at the shock, not from even just an inflationary perspective, but also from a demand and a growth perspective, you get a pretty material hit to GDP. I mean, if you shave the labor force by 6 to 7, maybe upwards of 8%, GDP growth and labor force growth track each other really closely over time. So it's pretty plausible that you would get a severe negative reaction for overall GDP. And I think even on top of that, what has been the trend over the past 4 to 5 years is that we've just become more reliant on immigration in terms of the growth of our labor force. So the almost 100% of our labor force growth over the past 4 years has been foreign-born individuals, has not been domestic-born individuals. So I think that needs to be taken into account in understanding the potential hits that you do have to the rest of the economy, especially in the services economy, which we've become much more reliant on in the post-pandemic era. So that, to me, is a bigger risk, but I don't know how much of a growth risk it would be even maybe in the first half or first 3 quarters of 2025, because if it's a slower rollout of individuals either being deported or if you're curbing immigration into the country, that takes time for it to sort of feed over into growth. So I could see a scenario where immigration policy is not necessarily the biggest growth risk for 25. Maybe it becomes a bigger risk for even 26 or 27.
Is that risk underpriced in the market then from your point of view? And should investors be positioning differently to hedge against that risk?
I think it's underpriced, but it's just not priced at all because we just don't know what the meat on the bones is. We just don't have really a precedent for that. So in in many ways, and I've been a musician all my life, and I'm thinking of kind of sight reading going into 25. Sight reading being you've never seen a piece before, you're kind of playing it as you go along. That's basically, I think, what we're facing. Not as much from a tariff policy standpoint, because we have a little bit to work from in terms of the first Trump administration, but certainly from an immigration standpoint. I mean, these sort of levels that you're talking about, upwards of 8 to 9 million people, which is the estimates from Pew showing how many undocumented workers are in the labor force. That is something that we really haven't seen before in terms of the scale, the scope and scale that Trump has been proposing.
And Kevin, before we let you go, I just want to quickly talk about what we've seen in the Mag 7 and what it represents for next year. We've seen Tesla, the best performer of the past month, and NVIDIA, the biggest laggard of the group. What does that tell you about a rotation in tech heading into 2025?
So I think that as the chart kind of puts an exclamation point on this, the theme and part of our theme, which has been pretty much the case for all of 24, and we think this persists into 25, is number one, you're likely to continue to see these really aggressive rotations into and out of groups or sectors, whether it's the Mag 7 versus the other 493, whether it's tech and communication services at the expense of the rest of the market. But I think even within groups now you're starting to see this wider dispersion. I mean, the performance gap that you noted between Tesla and NVIDIA, even over the past month, it's amazing that you would look at just the group of the Mag 7 and see that it has spiked, but it's been almost disproportionately driven by one or two names. So I think that is probably a more important theme to keep in mind, especially because the biggest companies are not always the best performers. And year to date, you've seen that where NVIDIA, yes, still second best performer in the S&P, but Microsoft is in, I think, 205th place. So you've got a huge gap between two companies that are still called magnificent in terms of the group that they're in. And I don't cover the stocks, it's just looking at performance. But it's just looking at the idea that there are other opportunities out there, and that is sometimes exacerbated by some of these rotations that you tend to get, notably the one that we've seen over the past month.
Sounds like breadth matters, regardless of whether you're looking at 7 stocks or 500. Kevin, thank you as always. So appreciate you coming in.
Nice to see you guys.
Thank you so much. We're going to take a look at some market headlines to start the hour here, sponsored by Tasty Trade. Let's start off with a look at the major averages still under pressure this morning here. You've got the Dow, the S&P, and the Nasdaq moving to the downside here. The S&P down just about 0.3%. The Nasdaq hit a little harder here, down over 0.5%. And part of the reason we're seeing this pressure is off the back of that economic data this morning. Producer prices coming in hotter than expected, and jobless claims ticking up as well. We saw that playing out in the bond market. If we can flip the board over to treasuries here, we'll take a look. Yields still moving to the upside following some of those producer prices. And it was interesting seeing the 2-year yield in particular really dipping to session lows on the back of this morning's economic data. I do want to switch over to Bitcoin. This morning, we just heard from President-elect Trump about his bullishness on Bitcoin here. And you can see that playing out in the price action, up over 1.3% this morning.
Now time for one of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's all done at Yahoo Finance's trending tickers page. Let's take a look at Warner Brothers Discovery, saying that it is restructuring its business. You're looking at gains, a massive move to the upside, just about 13%, creating 2 operating divisions, one that's focused on cable TV business, the other that's focused on streaming and studio. CEO David Zaslav saying that the new structure is going to, quote, enhances our flexibility with potential future strategic opportunities. The company expecting to implement the new structure by mid-2025. Lots to unpack here, but when you talk about the significance of this, so the unit that's housing Max, Discovery Plus, HBO, that's going to be merging here with Warner Brothers movie and TV production operations. That's going to create the unified streaming operations. And then on the other hand, you have TNT, CNN, TBS, HGTV among the cable unit there that has seen a little bit of pressure here, obviously, most recently. And when it comes to what ultimately maybe this means going forward, I think that's when we really get to the crux of the issue and something that we have been discussing time and time again when it comes to the evolving media landscape. And I think it's really emphasizing the growth here within the streaming business while also addressing some of the declining profitability that we have seen on the cable side of business. And I think it also just better aligns with some of the trends that we have seen more broadly speaking when it comes to the larger competitors in this space, especially on the streaming side when it comes to names like Amazon and when it comes to names like Netflix.
I think it's fascinating in the context too, of what we've seen with Comcast, talking about a similar situation in terms of spinning off its news division in particular, and kind of the chaos that caused, at least for employees from those news outlets too. And also just taking a really quick look at the analyst ratings on WBD, still very mixed here. You've got about 45% of the street with a buy, 50% hold, and one key sell rating there. We're going to flip the board over because activist investor Starboard Value has reportedly built a stake in Bitcoin mining operator Riot and is pushing for changes at the company. That's according to reporting from the Wall Street Journal. Starboard reportedly wants Riot to shift some of its Bitcoin mining facilities, instead offering the space to AI data center users. So this is, of course, developing news this morning. We know that Riot has that $4 billion market cap, and we've seen the stock price really under pressure, down 25% year to date here. And as a miner, they do kind of use these high-powered computers to process transactions. Meantime, Starboard saying, hey, why don't we transition here and diversify a little bit, move over to data centers, which we've seen be incredibly successful, especially as the hyperscalers are utilizing a lot of these data centers moving forward here. And we've seen that investment not only impacting some of those hyperscalers, but also impacting broader, indices, ETFs that track some of that CRE movement as well in the space.
Yeah, exactly. I mean, if you put up a longer term chart here, Riot, it's also important to point out the underperformance that we've seen in shares here for Riot, which obviously is at the crux of some of these issues versus other players within the space. And you're looking at year to date, you're still looking at a decline, I believe, at just over 23%. But even on just a right half aside of that screen, you can see a bit of a drop off even since President-elect Donald Trump did win the election, very much in contrast to what we have seen more broadly speaking with the broader crypto industry. So again, Riot shares still trailing many of its larger peers out there, many of its peers, I should say, especially when it comes to some of the names that, Maddie, I know you're closely following when it comes to MicroStrategy or a name like Coinbase, which has very much outperformed since Trump was elected.
Absolutely.
All right, well, coming up, lawmakers pushing for major reforms in the healthcare space. We've got the details when Catalyst returns. The killing of United Healthcare CEO Brian Thompson in Midtown Manhattan has rattled C-suites across the country. Corporations are scrambling to protect their senior executives as police warn of an elevated near-term threat to business leaders. Now, there are wanted posters bearing the names and photos of murdered United Healthcare CEO Brian Thompson and other high-profile health insurance executives that have been posted around Manhattan this week. Videos shared on social media showing wanted signs that are plastered on scaffolding and green boxes. Other posters also don the faces of other top CEOs and were seen on green scaffolding down on Wall Street. That's according to videos that have been posted.
And healthcare companies are attempting to lay low in the wake of the United Healthcare CEO's murder, as lawmakers and patients voice frustrations with existing business models. Yahoo Finance's Anjali Kamlani joining us now with more. And Anjali, I'm so interested in getting your response as you've spoken with sources in the space just about how they're reacting, how they're feeling about the public response and what that means for them moving forward. What are you hearing?
Yeah, there's definitely unease and I would say straight up fear over the very real threat of being shot and being a next target. And that's something that you haven't seen really in the industry before, largely when there's been violence reported, and the increase in violence that we've seen in the recent years has been relegated to healthcare facilities or social service facilities where individuals are directly interacting with the patients. This is the first time where those who are in office buildings and in the administration are scared and are wondering how to manage this. I think the industry is grappling with where they need to sort of make comments or not. And for the first time, there hasn't been sort of this overflow of commentary. Statements usually come from the companies themselves or lobbying groups. We haven't seen any of those to address the really evident outrage against claim denials. Now, we don't know what the motive is for the suspect, Luigi Mangione, but we do know that there are some healthcare issues, and the recent developments, of course, will give us greater light into that. But without that motive and without knowing, the public sentiment is still geared towards these insurers and against claim denials. It's important to point that the denial rates are something that we don't know much about either, because companies do tend to keep that under wraps. The only insight that we've really had is from Medicare and Medicaid services, and those numbers show about an average about 20% of denials through the industry. So it really is an interesting time. I've had several executives willing to talk to me only off record, some who are part of small organizations willing to put their name to it, but generally the sentiment is nobody's going to say anything right now. It is still too dangerous to comment, and if you comment on the claim denial, it's going to be conflated with defending United, and you don't want to be put in that position.
Yeah, certainly. And Anji's done great reporting on this. Thanks so much for bringing us the latest on that. When it comes to the reaction that we have seen, more broadly speaking, obviously with the American public, but more specifically with some of these healthcare stocks and the reaction that we have seen since this tragic killing here of Brian Thompson. I also want to bring up one of the drivers of some of the movement that we've seen in the insurers this week. We had lawmakers introduce a new bill that would actually push some of the major reforms for PBMs. Talk to me about that and kind of what the latest is and what we could potentially see, or maybe what lawmakers are hoping to see.
Yeah, this fight isn't new, but this is the first time that we've seen a bill that looks to break up directly this control. So PBMs, we know the pharmacy benefit managers, help to direct patients towards certain drugs, and they see themselves as sort of the gatekeepers, if you will, of costs, similar to how insurers think about their role in the healthcare space. And that is something that has been pressuring independent pharmacies as these PBMs also are tied in with retail pharmacies like CVS, CareScripts, and Aetna, and then also with United Healthcare with its Optum Rx and then its mail order. And so mail order pharmacies, actual retail pharmacies, as well as other types of pharmacies are being put in this bill that was introduced by unlikely teammates, Senators Elizabeth Warren and Josh Hawley, yesterday. So what remains to be seen is whether whether or not this bill actually makes it forward than an introduction. It is clearly not going to be taken anytime this year into the next step. So it's setting up a battle for next year. You just saw on your screen the market share of these companies and where they sit. CVS, United, and Cigna, the big key players that could get broken up with this. In addition, we also know that the PBMs are about a 30% margin for them, or rather 30% of revenues come from these PBMs. And as the companies have focused more on the pharmacy, kind of keeping that money in-house, if you will, that has also boosted revenues in recent months and years. So that's something that it has been a fight, it's been ongoing, and it's something that we will see how this bill continues.
Yeah, and we've certainly been talking to sources ourselves on the show this week about private versus public sector, where the action comes in to make change in the industry. So Anj, thanks so much for bringing us your reporting on that too. We appreciate it. Coming up, we're speaking with the CEO of Archer Aviation, Adam Goldstein, about the company's new partnership with defense tech company Anduril. That's next right here on Catalysts. Air taxi maker Archer Aviation announcing a partnership with defense tech firm Anduril to develop a military aircraft with vertical takeoff and landing capabilities, otherwise known as eVTOLs. Anduril's Chief Executive Officer Brian Schimpf spoke with Yahoo Finance about the defense sector at our Invest conference. Here's what he had to say.
The biggest theme I'm watching in 2025 is honestly on the defense side, on the foreign policy side, what really happens around all the conflicts we're seeing worldwide today, right? This is a hugely geopolitically unstable time, and we are very motivated to solve that problem and help the U.S. be as strong as possible.
Joining us now with more, we've got the CEO of Archer Aviation, Adam Goldstein. Adam, thanks so much for being with us this morning off the back of this news of more investment and also the partnership with Anduril. I wonder how investors should be viewing this partnership. Is this a strategic move for Archer moving forward towards a more defense-specific approach?
Yeah, it's great to be here. So today we announced the Archer Defense business unit, which is a business unit that will leverage all the technologies that we have been working on the commercial side. So yeah, absolutely. There's a good way to think about this is expanding kind of what we already do. But we also announced the exclusive partnership with Anduril to build the next generation vertical lift hybrid aircraft. And of course, Anduril being the premier defense tech company in the world, that's an amazing partner for Archer. But the investment community, was very positive on this as well. And we raised an additional $430 million of capital to go alongside it. So this was a pretty big moment for Archer where we have gotten the technology mature enough to where we could actually start expanding the different business units.
Yeah, you mentioned the capital raise or the funding round of $430 million. I'm curious just what we can gather from this in terms of what this signals about how Archer is then going to prioritize some of that spending then going forward and what that looks like surrounding commercial projects.
Yeah, so the good news is that the commercial program with the aircraft that's called Midnight is very mature and very late in the process. And so we are on the verge of commercializing and launching as early as fourth quarter next year. So we've mentioned several different places where we'll launch, likely to launch first in the UAE. There's a process in place to get that going. We've made many announcements along that front. And so as that program has matured, many of the engineers will start rolling onto the new program where we're building these new hybrid electric aircraft.
Well, one thing that I'm interested in is when we're going to be able to get these aircraft in the United States. And I wonder how you're viewing the resignation of FAA Chief Mike Whitaker from this morning. He will be resigning on January 20th when Trump enters office. I know you're still awaiting clarity from the FAA in terms of just anything that you all need to prove out in the tech to be able to operate stateside. Is his resignation a headwind for you?
So the FAA has been very supportive of the industry. And in fact, just 90 days ago, they passed what was called the SFAR, or Special Federal Aviation Regulation, that laid out all the operational rules. And Mike Whitaker was the head of the FAA when this happened. And so that was a very positive moment for the industry. That being said, the new administration seems to be leaning towards an environment that is, I would say much less restrictive from a regulatory perspective, which I think is a huge positive for the industry. So we do have a pathway to go launch internationally. And of course, I think that will in turn put a lot of emphasis on making sure that we can also launch here back in the US. So I think net, the change will be relatively neutral to the industry, but I think the new administration is going to be extremely positive for the industry.
Okay, well, given that, I want to ask you about something we heard from President-elect Donald Trump this morning, speaking at the New York Stock Exchange about military weaponry specifically. Let's take a listen.
The power of weaponry today is the biggest threat we have, in my opinion. It's not some of the other things that you read about. It's the power of weaponry. The weapons are so powerful, so devastating.
How are you viewing the potential impact the incoming administration could have on your business?
Yeah, I think there's a lot of initiatives that have been laid out and a lot of, let's call it ideas and themes that have been laid out that we fit directly into. So, for example, building new unmanned systems, I think is very important to diversifying some of the technology that we have today in the defense forces. I think that's a pretty big deal that we will fall squarely into. I also think building systems that are at a much lower cost is really important. And so, of course, we've heard a lot about DOGE and all the different things, but there are ways to actually maintain a similar level of capabilities, but do it for much lower costs. And I think we fit squarely into that as well by building these new hybrid electric aircraft. The main pitch behind eVTOL from the very beginning was always around cost, safety, and noise. And so cost being a huge part of where they're trying to cut, I think this fits directly in the path. And I think the new administration will be very positive for what we're doing.
And Adam, just zeroing in on Musk's role when it comes to DOGE, when it comes to some of the efficiencies and what exactly he has laid out there, how big of or how critical of a factor do you see that in driving some of this adoption, what ultimately it could mean for Archer?
Yeah, I mean, we've seen comments from President Trump. We've seen comments from Elon Musk. We've seen comments from pretty much a large member of the new administrations that there needs to be new solutions that meet a modern day challenge. And then we need to find ways to do that are much more cost effective and also much faster. And that's exactly why you're seeing the defense industry start to leverage and work with more of the new startup companies that are much more flexible and much faster. Archer has built 3 generations of aircraft in 6 years. And the leadership team at Archer has built 8 generations of aircrafts over the last 16 years. I don't think there's any other company in the world that's been able to do that at speed like that. And so by leveraging these types of companies, I think it gives everybody an advantage to sort of change the way that we've been doing business and really try to make sure that America can maintain its leadership position.
All right, Adam, thanks so much for taking the time to join us here this morning.
Thank you.
Financials have been on a tear into Trump 2.0. Now this coming as deal making and private credit continue to get a boost ahead of anticipated policy changes. For more on the big themes to impact the banking sector heading into the new year, we want to bring in Alex Blostein. He is Goldman Sachs Global Investment Research Senior Analyst. It's great to have you on the program. You know, it's tough to have a conversation with one of the top strategists on Wall Street and not talk about the opportunity that lies ahead for the financial industry. I'm curious, as you just wrapped up your 2-day financial services conference, what was your biggest takeaway just in terms of some of that optimism and confidence that you heard as you look ahead to 2025?
Yeah, great. Well, thank you for having me. Pleasure to be with you. So we did host a conference over the course of the last 2 days. We hosted about 100 executives across the financial service industry, ranging from banks to brokers to asset managers. So it's a really wide range of perspectives. So it was a great way to get a check on the pulse of the industry heading into 2025. And what I would say is there's a number of takeaways that really stood out. To your point, there's a lot of optimism there around the economy, and we got a couple of data points supportive of that. I'd say second, the amount of capital market activity, the pent-up capital market activity, seems to be translating into some of the more actionable steps. So whether it comes to equity markets or M&A activity, that is likely to accelerate pretty materially into 2025. The other theme we've heard, and you mentioned private credit, but I would expand it out a little bit broadly. All things around private markets continue to feel really healthy. And for the last several years, it's been largely the story of private credit. We're starting to see that broaden out a little bit into private equity. It sounds like things in real estate are starting to get a little bit less bad as well. And the last point I would make, and we can dig into all of these, there's still tremendous amount of capital sitting on the sidelines. So there's something like $7 trillion of money sitting in cash, money market funds, that is starting to make its way into the market. It's starting in fixed income. It may extend into equities. But all of these things seem to be really bullish for financials into 2025.
What's kind of the third level play for the money market funds, that cash sitting on the sidelines? How likely do you think it is that we could see some of that money flow into something like private credit heading into 2025?
Yeah, so these are kind of slightly different factors, I would say. The growth in private credit has been a bit more structural, and we continue to like that theme a lot for the whole space. It has been unfolding on the institutional side for quite some time. Wealth management and retail has been a newer growth opportunity for the space. We've seen a number of very large asset managers pursuing this opportunity both organically and inorganically, and that is likely to continue. We don't really see any signs of that slowing down. The more cyclical aspect, which is more traditional style funds, is where you're probably going to see a bigger incremental impact from a cyclical perspective. So that $7 trillion that I mentioned, typically that would go into bond funds or equity funds. We would have thought that the fixed income industry would have seen more of that flow at this point in the cycle already. That hasn't happened yet, but as rates start to come down and the yield curve steepens, we think it's a tremendous amount of capital that could move back into the market.
Alex, you mentioned that deal activity. You mentioned some of the confidence that you're hearing from executives at the conference, also I'm sure from some of your clients. When we talk about what that uptick is going to look like, I guess how big of a dramatic change are you expected to see here in the next year?
Yeah, so the two areas that people will talk most about is equity capital markets and M&A. On the M&A front, we are running about 10 to 15% below cyclical averages, and that is not adjusted for the notional, right? So the markets went up quite considerably. So you could argue you could be up, 15, 20, 30% in terms of M&A volumes over the next couple of years. If you look at the equity capital markets, in 2024, I think we've been running something in the 30 to 40% below where we peaked in kind of 2021 period. And there's a lot of pent-up demand. We think a lot of companies that I cover, the private markets firms, private equity firms, they have not returned a ton of capital to their clients over the last couple of years. So we think they will use both the M&A route as well as the equity capital markets route to get some of that capital back out. Because frankly, two things, right? Financial conditions are very easy. Spreads have contracted pretty materially. So availability of financing across the banking industry and the private credit industry is probably as good as it's been in a long time. So financing conditions getting better is a good sign. And then, of course, equity market valuations are running pretty high as well. So that should give people an opportunity to actually deliver on some of those exits.
So to put a bow on this a little bit, do you anticipate 2025 finally being a big exit year?
It feels like it, right? When you take that pent-up demand and when you also couple that with probably a more relaxed regulatory backdrop, that should feel pretty good. Whether it's antitrust dynamics getting a little bit easier, or as I said, just financing conditions continue to be pretty strong, I think that creates a pretty healthy recipe for some of that exit activity to finally kick in.
Alex, investors right now, or our audience who's looking to take advantage of this, what's the top pick then, the top play?
Yeah, look, we continue to like alternative asset managers. It's the space that we've recommended for quite some time. Some of our top picks there continue to be KKR, Apollo, TPG. TPG is a place where the multiples have not run as much, and they're quite levered to this private equity cycle. It's still the majority of what they do. When you look at KKR or Apollo, very different type of companies, but levered to a lot of the same themes as well. With Apollo in particular, you brought up private credit. It's a place where we continue to see a long runway, and then they're one of the better companies positioned to benefit from that as well.
Alex, thanks so much for joining us. I should also mention that Apollo is the parent company of Yahoo Finance. Coming up here, we are getting an insider's take on the outlook for commercial real estate. That's next, right here on Catalysts. A string of sticky inflation readings could complicate the Fed's policy path into next year, making rate cuts fewer and further between. Joining us now to discuss what ultimately higher rates could potentially mean for the commercial real estate market, we want to bring in Hassam Naji. He is the CEO of Marcus & Millichap. Hassam, it's great to have you back here on set. Thanks so much for
Thanks for having me. Great to be here.
So let's talk about some of the changing narrative that we have surrounding rate cuts. There was lots of optimism just about the number of rate cuts, the extent of the cuts that we could potentially get, and we're seeing that change a little bit here, especially over the last couple of days. I'm curious, does that at all change the comeback narrative that we've been waiting for and hoping for when it comes to CRE?
It's amazing how sensitive our business is to interest rates, especially for the private individual investor, the high net worth investor, even small partnerships, which make up the vast majority of commercial real estate ownership. They are very sensitive to what interest rates basically do from a trend perspective and what they're going to do. So if the marketplace expects interest rates to come down, they tend to wait, obviously, if you're a seller, because that's going to be favorable for values. If they're going to go up, it's the reverse. It is extremely important that the Fed be clear in its messaging. So the fact that the Fed has basically done a lot of bait and switching has been very damaging to the momentum of commercial real estate trading. I think looking ahead, the market is beginning to come to terms with the fact that we're not going back anywhere near the lows of the previous cycle. The inflation pressure is waning, but it's not going to go away. So the Fed is going to be limited in just how aggressive they can be in lowering rates. Our clients are starting to accept that. And therefore, they're looking at other metrics like replacement cost. If you look at the value of commercial real estate, it's declined by 20 or 30% since March of 2022, which was the market peak. Obviously, when interest rates go up as much as they have, that's going to reflect on values. Values have come down. And for a lot of investors who are seeing unique properties they've wanted to own for a long time, they're paying all cash right now in order to get the right pricing, get the right asset, get the right market. And they'll put financing on it a little bit later when interest rates, probably come in from where they are today. The other aspect of the Fed versus the long-term interest rates is the breakdown between what the Fed does and what the 10-year Treasury yield does. The 10-year Treasury yield is what really drives commercial real estate lending. So we've seen the gyrations of that. And when we ran back up to 4.5% just a few weeks ago, just that made a big difference in market sentiment. But the optimism is all about valuations having corrected, job growth still being steady, but not so much that it really challenges the Fed. And the combination of the two, plus the fact that new supply is very limited. It's really expensive to add brand new development, brand new construction. So the supply side is cooperating as well.
Well, since you mentioned the supply side, I do want to go into some policy that we've been talking about this morning, especially with incoming President-elect Trump for the second time to the White House, talking a little bit about this morning at the stock exchange. But obviously, one of his policies that he is going to focus on day one is immigration, which will certainly impact construction and therefore supply. How are you thinking about and hearing clients think about pricing in that policy impact?
It has two different aspects to it. One is the workforce housing renter that tends to have a very large migrant population. If the threats of deportation and so on really do play out at the scale that Donald Trump is talking about, that would affect a lot of gateway markets, Class B and C apartment renters. Most of our clients aren't anticipating the scale of execution of some of the campaign messaging. They don't think it'll be as big as it's been kind of voiced. And then on the other side of the equation, not just on the construction labor force, which would be affected, of course, but also when you hear things about tariffs and trade conflict with our trading partners, that affects supply, that affects lumber prices, that affects all kinds of aspects of new construction. Suffice to say that there's just a lot of chatter out there, but we don't know what's going to actually happen. What people say versus what they're able to actually execute are often two different things. So the market isn't panicking about that. Our clients certainly aren't overly concerned. And then on the positive side of the equation, the election outcome really does point to the fact that the 2017 Job and Tax Reduction Act being more likely being extended or even maybe improved has multiple positive aspects for commercial real estate.
Hassan, when you take a look at the various aspects of CRE, we've seen some strength in industrial, we've seen some strength, especially when it comes to maybe the retail landscape, and I know it's something that you've closely tracked. How should investors be thinking about that investment opportunity? Because there still is a lot of weakness in office, and I think when a lot of people think of CRE, their mind directly goes to office, but that's only one small portion of the pie.
Thank you for acknowledging that, because the whole industry gets a very warped perception because of what's happening with office buildings. in so many ways, we refer to retail as the new apartments and office is the new retail. Because as you know, over the last 20 years, retail real estate, brick and mortar retail has been under so much pressure because of e-commerce, and the industry has dealt with it. There's been so much reimagination and renovation of retail space that has positioned that specialty to come back really strong. I'm part of the ICSC trustee group. ICSC is the largest trade group for retail owners and retailers. And the optimism and the amount of lease demand is at a 20-year high. Because people are going back into stores, digital brands are creating brick and mortar, at least showrooms, not so much a big inventory footprint, but a showroom footprint. And so retail is right now the darling of the industry. Apartments are doing great. People can't afford to buy homes. Affordability is at an all-time low when it comes to buying versus renting. And that really points to unbelievably strong renter demand on the apartment side of the equation. Obsolete, older, urban office buildings is where the pain is because of the fact that the people have been reluctant to come back into the office. But what companies have done is basically consolidated their space into higher quality Class A office building choices. And it's the older, obsolete product that's really hurting. And those are hard to convert. They're very expensive to convert, and they're not as easy to reimagine as shopping centers were over the last 10 years.
All right, Hassan, we got to leave it there. Thanks so much for joining us.
Thanks for having me. Great to be with you. Thanks.
Coming up, Bitcoin ETFs have seen massive flows in just under a year of trading. We're going to dive into the outlook for the market next, right here on Catalysts. Spot Bitcoin ETFs seen record flows just under a year into trading. Since President-elect Donald Trump's victory alone, the 12 ETFs have seen about $10 billion of inflows. These ETFs are now the largest holders of Bitcoin, even surpassing its creator, Satoshi Nakamoto. For more on the ETF market as a whole, we've got John Mayer. He is the chief ETF strategist at JP Morgan. It's great to have you in studio, John. Thank you so much. It's interesting, not only the flows that we've seen into Bitcoin ETFs, but this morning BlackRock saying that they came out with this recommendation of 1 to 2% exposure to Bitcoin ETFs because of the amount of questions they were getting from clients about it. How are you fielding those questions, and how are you thinking about Bitcoin ETFs as a competitive factor in the broader market?
Sure. JP Morgan does not have any Bitcoin ETFs, but what I think it really shows is that the versatility of the ETF structure in and of itself, that various different asset classes can be utilized inside that structure. and how that can be infused into different portfolios. Certainly, certain places want 1 or 2% exposure, but that's really a personal decision in terms of asset allocation. But again, the choice is there, and the ETF provides many different choices, and that's one of the key aspects, the accessibility of the ETF structure.
When it comes to some of that growth and opportunity and interest, more broadly speaking, I think even when you talk about the adoption in the mainstream, kind of going back to Maddie's point, and what we've seen, the reception for Bitcoin ETFs just really speaks volumes about how far this industry has come and what that involvement has looked like. When you take a look out to 2025, where are you seeing those most attractive opportunities, or where you're expecting maybe to see the most activity then in the new year?
Well, first of all, we just hit over $1 trillion in flows this year. That's the first time ever, so that's quite incredible. So it's about a $10.5 trillion industry at this point. So it's huge, $14 trillion globally. What you are seeing, some of the trends, particularly in the US, is the issuance of actively managed ETFs. Yeah. So think about this. There's 8% of the assets are active now, but 30% this year of the flows are actively managed ETFs. So there's been a real shift in towards both the issuance as well as flows into actively managed ETFs, which is really kind of a shift in the overall industry.
That's fascinating to me, because to me the finance 101 is like park your money in an ETF because it's a way to hedge and not be actively managed. It's a passive investment vehicle. Explain to me that shift that we're seeing and how kind of investors who are looking at this as a method of retail investing should be viewing that.
Well, ETFs grew up passive, but certain regulatory changes that occurred at the end of 2019 allowed for issuers to have benefits in terms of PBMs could do different things in terms of tax efficiency. And then 5 years later, from the end of 2019 to now, you're experiencing 3- and 5-year track records for a lot of different ETFs. So you're seeing a big shift in the overall asset management business into the ETF space because of that versatility of the structure. They're liquid, they're accessible, they're cost effective, and they're tax efficient. And the superpower really is the tax efficiency. So, I mean, that's really what's driving this.
And John, there's a ton of it. There's more active ETF products available, I believe, than passive ones here, but they still only represent, I believe, about 15% of total assets under management, if that's correct?
Well, overall, in fixed income, yeah, 15%, and overall, 8% of assets.
So overall, 8%. What do you think those numbers then look like, given the growing popularity of actively managed funds?
Well, if you think about the flows this year, 30% of the trillion-dollar flows have been into active. So that increases every single year as you are seeing different mutual fund managers get into the ETF space. And when you gain that track record, that helps you get onto different platforms, that helps the distribution, creates the awareness, and then you have the optionality to use an actively managed ETF for many different clients.
Well, John, it's great to have you here on set. Thanks so much for taking the time to join us. That does it for Catalyst today. Keep it right here. Wealth is coming up next.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we'll talk about the markets and the best and worst positioned sectors heading into 2025. And the Consumer Financial Protection Bureau has new bank overdraft rules that will greatly reduce how much Americans will have to pay. We'll bring you the details on that. Plus, Bitcoin, it's been lingering in that ballpark, trading around $100,000 for the last week. Is there still time to jump in? Well, we'll discuss how much crypto you might want to consider having in your portfolio. All that and much more during today's show. But first, we are 90 minutes into the trading session. Let's take a look at some of the market action here as we've got the Dow, the S&P 500, and the Nasdaq in negative territory. So a little bit of a pullback after a hotter than expected producer price index reading. Joining me now, we've got Vance Howard, Howard Capital Management CEO and CIO. And you're looking at sectors for 2025 here. Tell us which you think are best positioned, and then we'll get to the worst position in a hot second.
Okay, well, as we know, our proprietary indicator, the HCM byline, is positive, so we see any pullback as being positive. But sectors, I think small caps are incredibly interesting right now because as interest rates are lowered and being dropped, that's going to dramatically impact the earnings on small caps and really be beneficial to them. I think that's a great place to play. Regional banks look good to us also. I think with a lowering of rates, I think the regional banks are going to be a strong place to play. And again, consumer discretionary has always been quite successful in a market like this. But again, we're in a solid bull market, so there's a lot of places to play that are making a tremendous amount of money.
And what are the worst areas? What are the worst sectors that you think investors should be cautious around right now?
The main sector that I would be cautious, and mainly because it's in a downtrend right now, Brad, is healthcare. Like if you look at VHT on the Vanguard's healthcare ETF, it's in a downtrend, and it's in a pretty solid downtrend. Keeps making lower highs and lower lows all the way down. So I'd be very cautious on healthcare. I wouldn't make that trade trying to bottom fish there either, because there's too many great opportunities right now in this fantastic bull market to make money and to try to expand your portfolio in areas that are really working. We had the Magnificent Seven, but the market's clearly broadened out, which is incredibly bullish and incredibly positive.
That's so interesting because some of the data from Bloomberg Intelligence is still looking for even 20% earnings growth, profit growth rather, and for 2025 within healthcare. What do you think is, if we do see that level compared to the 18% that's expected for the Magnificent Seven and the 16% expected for materials, if we did see 20% profit growth in 2025, what would need to happen for healthcare to actually achieve that marker?
Well, that's an interesting thing when you look at it too, Brad. And one of the things we really analyze a lot is the technicals on a different trade, whether it's an ETF, whether it's a stock or a sector. And the technicals on healthcare just aren't there. It's in a downtrend, and I don't want to fight that trend. And as far as they're making money, it's a solid industry, but I wouldn't fight a downtrend in a great market when you've got all these wonderful stocks that are making new highs. You got wonderful ETFs making new highs. So I just wouldn't fight the trend. I think if you fight the trend, it's a great way to lose money.
And so as you're thinking about some of the trades that have been overcrowded over the course of this year, naturally the Mag 7 comes to mind. How do you anticipate that the trade will continue to hold up, especially given the thesis that's been layered on top of that, which has been essentially all things artificial intelligence?
Yeah, I think that's a great question. But one of my bigger picks is Salesforce. I really like Salesforce. I mean, it's breaking out. Its technicals look strong, but they're able to implement AI in such a way that I think it's going to be very impactful for the users, for the end user on Salesforce. So I'm really bullish on things like this. You look at NVIDIA, and they've got like the Blackwell accelerator that just came out, which is going to make their chip even faster. And as those chips start to expand into other industries like healthcare, it could be a great benefit to healthcare. It's mainly been in data mining and gaming as far as these chips are concerned, but they're really broadening out to where they're having a big impact in other sectors of the market. So there's a lot to be excited about as far as breakouts in stocks that are really working well.
It's interesting. You mentioned Salesforce. I wonder what your assessment is of the rest of kind of the ERP or even CRM landscape more broadly as they're trying to pitch out to their clients what their AI features, and we've heard agents tossed out there a lot at this juncture. What is the timeline for that to really play out, and the new baseline that you're anticipating might be set in as well as a result of netting out some of those net new customer contracts?
Well, I think when you look at Salesforce and you look at what they're doing with AI, I think they're on the cutting edge. They've got a tremendous amount of money behind them, so they can actually, do their R&D research in there and sort of start to game the market in a better and more productive place. And that's one of the reasons I'm so bullish on it. And another reason, when you look at CRM packages like Salesforce, they have what we love, which is recurring revenue. When a subscriber signs up for Salesforce, they have to pay a monthly fee, which is, by the way, quite large because we use Salesforce. But I love recurring revenue. I think that's a great way to judge a company is, and you look at waste management companies, they have great recurring revenue too. But as far as CRM goes, I think the Salesforce is one of the more dynamic stocks out there that's actually implementing AI right now and going to make some great headway with it.
Interesting. Vance, thanks so much for taking the time here with us today. Really appreciate it.
Thank you, Brad.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we've got soft drink makers Coca-Cola and PepsiCo, plus Keurig Dr. Pepper, all upgraded to buy from hold at Deutsche Bank. The analyst Steve Powers, more positive on non-alcoholic options heading into 2025, but still warns investors to stay selective on consumer staples next year with challenges in the sector ahead. Next, the same analyst from Deutsche Bank also initiated coverage of energy maker Celsius, energy drink maker, but I guess as a byproduct, energy maker too. While JP Morgan, they initiated it as overweight. JPM analysts touting upside from branding, broadening out from just the typical energy drink market. Attracting, get this, affluent female consumers, rounding out our consumer staple options as well here. We've got General Mills. We had to check in on this one. Why? Oh yeah, expanding its Cheerios lineup with a protein product. You heard that right. According to the cereal maker, 71% of consumers are trying to eat more protein. Their new offering provides 8 grams per serving. Some in our newsroom say that's still not enough. The latest November CPI print that came in line with estimates, but signaled still stubborn inflation. Catalyst co-host Madison Mills joins us now with a closer look at where inflation still is showing up in your household budget. I mean, hopefully, and maybe not in those Cheerios right now.
Not in the Cheerios. That was actually one category we saw prices coming down in. But I did want to focus on where we're seeing this kind of vibe session still lingering. Consumer sentiment about inflation still under a bit of pressure, right? And one of the reasons behind that is potentially that the things that are the most expensive purchases of our lifetime have continued to skyrocket during this season of inflation that we are in. Now, there were some signs in the latest CPI print of that cooling off just a bit. So we've got a mix of good and bad news I'm going to give you here. Now, just to level set, the things that are incredibly expensive in our lifetimes here, right? The likes of shelter, that was up 4.7% over the last year. Motor vehicle insurance, so think about your monthly car payments, up 12.7%. Medical care, 3.1% increase. That's also a huge part of what makes us feel like our monthly bills are expensive. But if you look at the chart on your screen here, you can see owner's equivalent rent and rent of primary residence all trending to the downside. Some reports I've been reading in this morning saying that this could be a sign that the worst is over when it comes to shelter inflation, but you still see positive numbers, right? So that means that your rent, it's still going up. It's just a question of whether or not it will ever get to that deflationary period. And for that to happen, you probably need a recession. So it's very unlikely. It's just that the rate of increase to the upside is starting to slow down. I also want to flip over to autos. We are starting to see vehicle costs dissipating as well, moving a little bit sideways here. You can see on your screen here, used cars and new vehicle costs both moving to the downside here, but those high insurance costs I mentioned at the top, that's still keeping things tough for those individuals who are car owners. And the last big ticket item I had to pull out today, of course, eggs. A quarter of the November rises in prices for final demand goods in the PPI print is attributed to a 54.6% jump in chicken eggs. And we know that the price of eggs went up over 8% over the last month in the CPI print. So for those who have high grocery bills, the eggs may be a big part of that, and the beef as well. Beef costs went up as well.
All right, Maddie, thanks for breaking that down and everything that is going to be making its way into and out of my refrigerator pretty soon here. Guys, coming up, tax traps on social media. We've got tips to help you avoid them when you see them. That's next on Wealth.
Costco. It's one of the hottest memberships in the world with over 128 million cardholders globally. 3 types of Costco memberships exist: the base, also known as Gold Star, Business, and the Executive membership, which is the highest tier. All 3 had their first price hike in 7 years, with prices officially rising on September 1st. Today, Gold Star members pay $65 per year to get access to Costco online and warehouses. It also includes 2 free membership cards, so you can bring a friend and shop for some big deals. And if you own a business, the business membership is for you. It's pretty much the same as a Gold Star, but you're allowed to purchase for resale. Now the highest tier, the Executive membership. It's double the price of the Gold Star and Business tiers, clocking it at $130, but there are some added benefits. There is a 2% annual reward on all eligible Costco purchases for up to $1,250. So if you spend $500 a month at Costco, you'll get $120 back annually. And there are some extra discounts on Costco services as well. Just like the Gold Star membership, it comes with 2 membership cards. All 3 of the memberships gets you exclusive access to the wholesalers' warehouses, where you can buy pretty much anything and everything, from music instruments and jewelry to even a barn. And of course, the infamously hard-to-get Costco Gold Bar. But ultimately, a membership isn't right for everybody. First, if you don't live near a Costco, it probably is not a good idea to get a membership. And you also need to evaluate how much use you would actually get out of that card. How many people live in your home? How often do you plan on going? How much do you plan on spending? All questions you need to ask yourself before coughing up that annual fee.
Costco reports first quarter earnings after the bell today. Yahoo Finance will have you covered with all of the results on market domination over time. Well, the Consumer Financial Protection Bureau has announced new rules intended to save Americans billions of dollars in fees each year. The CFPB is giving banks and credit institutions and unions with more than $10 billion in assets 3 options when charging overdraft fees. The first, capping the fee at $5. This is the estimated level at which banks could be able to cover the costs associated with overdraft programs. This would represent a drop from the $35 that institutions typically charge, according to the CFPB. The second option, banks can charge enough to cover their costs and losses without making a profit. And the third option, for firms that don't want to profit, they'll need to treat it like a regular loan, explain the terms and conditions, have customers opt in, and the new rule is expected to add up to $5 billion in annual savings to consumers, about $225 per household. This change is expected to take effect on October 1st, 2025. Well, Bitcoin is trading above the 100,000 level today. The post-election rally continuing as investors are encouraged by reports of a pro-crypto candidate to lead the CFTC, the Commodity Futures Trading Commission. Here with more on crypto investing strategies, we've got Chris Gennady, who is the global head of research at WisdomTree. Chris, good to have you here with us. So just with the rally that we've seen thus far and now getting back above 100,000, it seemed like a psychological milestone. However, once again, there's a larger question of, all right, where do we run from here? What's your best kind of estimation and calculus around this?
Yeah, so it's been fascinating to watch as various things have happened in 2024. I know we almost forget about it because it feels like so long ago, but back in January, we had the approval of the Bitcoin ETF that was backed up by the actual Bitcoin as opposed to Bitcoin futures. And you move through the year and they do the same for the Ether-based ETF. So they've sort of through the year broadened the investor base. You don't necessarily need to do the wallet or do the more complicated things anymore to gain exposure. And then obviously you conclude with the election result where you nailed it, whether it's the SEC, the CFTC, various other policymakers, the spending and supporting of various candidates during the election. Crypto is a massive force, but we remind anyone we speak to, right now, it's about excitement, it's about potential, but all these people we're talking about, they're not even actually in the chairs yet. We've got to wait till January 20th and probably a little bit after confirmations, et cetera, before we really see that policy meeting the road.
From your own research, what has been the perhaps action thereafter? When we have this much excitement and this much kind of buildup, that's clearly looking out into the future and the potential of what a pro-crypto or a friendly to crypto type of regime could mean, but a larger question of how far out the investors and holders are looking at this juncture.
It's remarkable, and anyone out there that can think back a little more than 10 years at this point, it used to be that 10,000 Bitcoins would buy you a couple of pizzas. There's a very famous article that people can look up. The asset itself for the last 10 years has delivered more than a 50% annualized return, which basically means it's doubling roughly every year and a half. But at the same time, the volatility is almost 80% annualized. And at the worst point, and this is the tricky part, and this is why we see a lot of allocating within a portfolio, maybe a 1, a 2, a 3%, as opposed to, dumping all the money in there. Because at one point in the last 10 years, there was an 83% drawdown, which basically means $100 became $17 at a particular point. That's very difficult psychologically to live through. So there can be some huge swings in this asset.
When we think about what has been talked about on the campaign trail for President-elect Trump, building a strategic Bitcoin reserve, and I might add that the U.S. already has, by and large, the most Bitcoin holdings right now compared to other countries at somewhere around 200,000. So with that in mind, how are you looking at what could be added on top of that pile, and would it be purchased? Is this something that might come because of seizures, and how would the government go about that, and what do the existing holders of Bitcoin think about it?
I believe the existing holders of Bitcoin are basically thinking, and the podcast ecosystem, the media ecosystem, where you can find and read the writings and thoughts of a lot of these individuals. Anything that encourages more and broader based holdings of Bitcoin is a positive. Looking at it from a government perspective, it's one of these amazing headlines, the idea of a reserve of Bitcoin. But you start looking under the hood and you recognize that it's a far more difficult process. There are certain things President-elect Trump can probably do with a stroke of the pen, like executive orders. It doesn't seem like a Bitcoin reserve is one of those. It seems like there would be a lot of steps, a lot more complexity. Not to say it's impossible, but just there are certain easier things that might help the crypto area, for instance, in thinking about currently we only have the ability in two assets, Bitcoin and Ether, to actually put into the ETF structure. Maybe when the new people come on board, that broadens out a bit. So there's a whole spectrum of policies and things that can occur. A lot of them are far less complicated than a Bitcoin reserve. A Bitcoin reserve itself, when we see how they go about it, where they're getting the coins, I think from there, it'll be a lot easier to come up with those final conclusions.
Bitcoin trading at 100,000 right now. How much of a portfolio should be allocated to crypto from your own assessment?
What we tend to see is somewhere between 1% and 5%, depending on the needs and the situation of the investor. You're starting to see institutions even take the plunge and gain at least some exposure. It'll be fascinating. There are these institutional consultants that basically in the past came up with the quote unquote 60% equity, 40% bond allocations. Maybe one day they're recommending a 2, a 3, or 4%. They don't do it yet, but allocation to Bitcoin. At the end of the day, the key thing here is to manage the recognition that yes, returns have been remarkable, but at the same time, in a given 10-year period, you also have to expect you could see an 80% plus drawdown, and structuring the portfolio to be able to live with that is why you don't tend to see much more than 5%, at least in most cases.
Chris Gennady, thanks so much for taking the time here today. Appreciate it.
Thank you.
Social media can be great for lots of reasons, but when it comes to financial advice, don't believe absolutely everything that you hear. Here with 3 TikTok tax traps that you should avoid. We've got Adam Brewer, who is a tax attorney at AB Tax Law. Adam, good to have you here in studio with us. Let's start with deductions here. What's a trap out there that folks should avoid?
Yeah, absolutely. So the first trap that we see a lot is this 6,000-pound vehicle deduction. So if you're on social media, you probably see posts about deducting your 6,000-pound vehicle, and it can be a great way to save tax dollars. But for most small businesses, for people with side hustles, we really don't want to see them tying up so much of their funds in a 6,000-pound vehicle. So there's better alternatives if you're looking for a year-end tax savings. Don't jump right to that 6,000-pound vehicle. What I'd recommend is instead make sure you max out your retirement contributions. So if you haven't maxed out your pre-tax retirement contributions at this point in the year, do that first. Don't even look at a 6,000-pound vehicle until you really set aside that money, because that's really where your wealth is going to be built.
One of the other traps out there, and we hear this talked about a lot and really rattling through social, is the write-offs and what can be written off, what can't be written off. Of course, a lot of Schitt's Creek fans out there may have had this top of mind as well. What are the traps of that, though?
Yeah, absolutely. So that's a huge trap. We've talked about it for a few years now. This is the one where, hey, go on a vacation, do a little bit of work, write off the whole thing. Just because you have an LLC, it doesn't mean it's a write-off. Going back to the old Schitt's Creek joke. And so that's what we want to see is really taxpayers, if they have an LLC, if they have a small business, do the work. Look for the legitimate deductions that you do have. I can't tell you the number of times I've seen clients come in with an audit or with a pretty bad tax situation, and they've had these questionable deductions. But when we really go through their expenses, there's legitimate deductions that they've overlooked. It's just they were too quick to jump to, the more questionable ones, like the vacation expenses, the meals, the dining, those types of things.
Interesting. And lastly here, what are folks missing about deductions when it comes to charitable donations? We just had Giving Tuesday a couple weeks ago here. What should people know about their charitable donations?
Yeah, so the big thing on charitable donations is if you want to give to a cause, give to a cause. But what we see because of the higher standard deduction is that more taxpayers than ever, they're not actually using their itemized deductions. And that includes the charitable contributions. So taxpayers who have historically used itemized deductions, they have their state and local tax, their mortgage interest, all of those have really been squeezed. State and local tax by a $10,000 cap, mortgage interest by 3% loans that a lot of people have. And so again, if you want to donate to a charitable cause, do it. But before you go all in and really write a big check, make sure you factor in, will that save you tax dollars? Because again, with the higher standard deductions, a lot of taxpayers aren't able to use those classifications of itemized deductions.
Is there a sweet spot to make sure that you're filing by in order to get your return back quicker?
I don't know that there's a sweet spot. I'd say the trick is to always file electronically. So if you can avoid submitting a paper copy to the IRS, file that return electronically. And then again, if you're able to file like late January, early February, whenever they do it, beat the rush. Also a great tip to avoid any ID theft issues. So a lot of times we see taxpayers who wait right up until the extension deadline. There's always the risk that someone's going to file a return in your place, claim a big refund, and then that's a headache that you don't want to have to deal with.
Really interesting. Adam, thanks so much for taking the time here and breaking down some of the traps versus the tips out there.
Yeah, great to be here. Thank you.
Certainly. Coming up, everyone, we've got your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day. It is time for Yahoo Finance's Market Minute. Stocks mixed after producer prices for November came in hotter than expected. The Nasdaq seeing the biggest losses on the day so far. Here are 3 trending headlines we are watching today. Bitcoin miner Riot Platforms getting a lift on a report activist investor Starboard Value has taken a stake in the company to push for changes. The Wall Street Journal report did not disclose the size of this stake. Broadcom shares are under pressure ahead of its earnings results. Investors will be looking for more clarity on AI demand, especially following a report the firm is partnering with Apple to develop an AI server chip. And shares of General Dynamics are lower as Goldman Sachs sours on the stock. The Goldman analyst downgraded it from neutral to sell, saying the defense and aerospace company could be hurt by Donald Trump's push to slash government spending, leading to a decline in the stock of more than 7%. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
Heading into the new year, we want to talk about retirement savings. How did Americans save for retirement this year, and what can we expect in 2025? Here with more, we've got Mike Shamrell, who is the Fidelity Investments Vice President for Workplace Thought Leadership. Mike, good to have you here on the program. So, how did people do in 2024 saving for retirement?
You know, we had a lot of really good news, at least especially in the third quarter of this year. We put out a report that analyzes trends in terms of behaviors and investments for retirement savers every quarter, and we had a lot of good news, but specifically there were two pieces from the report this quarter that we found particularly encouraging. The first was around just overall account balances. Those had increased for the fourth consecutive quarter, and they also reached a record high, just a little north of $132,000 on average. But the other piece of good news that we found really encouraging was around the savings rates. And we found that savings rates are holding steady, not only among American workers, but in terms of the company match that they're getting from their employer. The reason we found this encouraging is that it's an indicator of behavior, but also we know from our own research that a lot of people are concerned. There's concerns about inflation, there's concerns about the cost of living. We understand that people are probably making changes somewhere within their personal financial lives, but the good news is they're not pulling back on their retirement savings.
Mike, what are you seeing in the workers that are cashing out of their retirement savings?
So we, and when I say we, I mean we as an industry, had recognized that a lot of workers were cashing out when they moved from one job to the next. And the fact that a lot of younger workers are changing jobs frequently, that could work against them in the long run. And so Fidelity is part of a consortium that's known as the Portability Services Network. And what it does is it will automatically roll a worker's 401k savings from their initial employer to their new employer without the worker having to do anything. It all happens automatically. It all happens on the back end. This is important because, first of all, the early dollars, the dollars that you set aside at the beginning of your career, those are the dollars that are going to have the longest opportunity to grow. So you want to protect those as best you can. And it also just helps workers, gives them one less thing to worry about as they're moving to a new job, and helps keep their retirement savings on track. When we polled these workers to find out why they were cashing out, it wasn't necessarily because they needed money. It was more that they felt a little overwhelmed. They weren't quite sure of the process. They were afraid to make a mistake, afraid to get a penalty. So the Portability Services Network and the ability to automatically roll their savings from one job to the next is really encouraging. So Brad, we're up to 2 million workers on the platform and growing. So this is really good news for workers, especially workers with lower balances who might be early in their careers.
Some really interesting stats as well that were flagged here. 401k created millionaires, that actually jumped 9.5% in the third quarter from the second quarter here. And IRA millionaires increased by nearly 5%. All of this momentum in mind, what does that hold for 2025 in your outlook?
Well, we talk about the millionaires and we try to be pretty transparent in that this is a very small percentage still of our platform. And we're not necessarily saying that $1 million is what people will need. Some might need a little bit more, some might not need that much. But what we try to do, Brad, is we try to hold up the millionaires and demonstrate the behaviors that they had that allowed them to reach that milestone. So one of the main characteristics of the millionaires, both in the 401k and IRA side, is that they've been saving a long time. Average tenure, I think, is about 26, 27 years. So it's not like they found some hot stock that they added to their account and overnight they became a millionaire, had $1 million in their retirement savings. They are examples of taking a very long-term approach, staying the course, and taking a very consistent and regular approach to saving for retirement. So that's what we try to say to people, especially as we head into 2025, and there may be ongoing uncertainty in a lot of areas. Taking a long-term approach and making sure that you stay the course is probably going to put you on and keep you on the best path in terms of reaching your retirement goals.
Mike, just lastly, while we have you here, there's, of course, the thought about, should I be putting more into my 401k with the last paycheck of the year? Just with 30 seconds we have left, what's your advice there?
So probably a little late to do that for your 401k because that is taken out of your payroll. It takes a couple of pay periods for that to kick in. So probably late on the 401k side. IRAs, though, definitely plenty of time. So if you want to make that last minute contribution to your retirement before the end of the year, definitely consider making contribution to your IRA.
Mike, thanks so much. Mike Shamrell joining us this morning on this topic. We appreciate it.
Thanks for having me.
Absolutely. Well, Chinese-based company ByteDance, parent of TikTok, has until January 19th to sell TikTok or face a ban in the U.S. Our next guest says a ban would have an enormous economic impact. Here with more, we've got Michaela Alaka, who is the founder of Break Your Budget. Michaela has over 850,000 followers on TikTok, where she helps spread budgeting advice here. Michaela, great to have you here with us. All right, let's just talk about the impact that you're anticipating on content creators if this ban does indeed take place.
Absolutely. So I can only speak for myself, and I have earned over 6 figures every year over the last couple of years since 2022 solely on TikTok. So obviously it will have a huge impact on my business revenue, and I know the revenue of tons of other creators. All that to say, this isn't the first scare that we've had. This is probably the third or the fourth. So many creators, myself included, have started to diversify our content creation across tons of different platforms, including Instagram, YouTube. I also have an email newsletter and a podcast, and that's really helping to lessen the blow should this ban go through.
And so ultimately here, how does this mean that some of the creators right now, if this ban does go through, how they would have to take some of their followers or get their followers over to other platforms or convert that touch point into something different than how they're currently engaging with those followers?
Yeah, so with TikTok, we're already creating videos on a pretty regular cadence. Most content creators are posting multiple times per week. The really awesome thing that you can do is take that content and repurpose it across all different platforms without any additional work. So I take all of the videos that I make on TikTok and I repurpose them on Instagram. I've also been posting them on LinkedIn. I post them on YouTube Shorts, and that really helps to bolster your platform growth across all different social medias, which is really, really important. The other thing that I really think a lot of creators should consider doing is growing an email newsletter, which you can grow using social media, whether that be TikTok or one of these other platforms that I've mentioned, because you own your email list. So you don't have to worry about an app getting banned or an algorithm shadow banning your content when you have a follower's email address that you can communicate with and talk to via that channel.
You mentioned 6 figures in brand partnerships. What are some of the top ways that you're seeing creators really target working with companies and successfully pull off the brand partnership right now?
Yeah, so TikTok is a great avenue for that, not only through sponsored content that's posted on like a creator's channel, but also through UGC content. A lot of brands really need more social media content, and they pay creators to make that content for them to post on their own social media platforms. Another great way to monetize with brands on social media, TikTok, and again, all these other platforms is through affiliate marketing as well as usage. So a lot of brands that I've actually spoken about organically and naturally have come across my content and then paid me for usage rights so that they could boost those videos and run ads via their channels, but with the content that I've already created. And they also share discount codes and affiliate links so you can continue talking about those products and talking about those brands and generating income without having to create tailored sponsored content. That tailored sponsored content is generally the content that is the highest revenue generator, but there are tons of other ways that you can work with brands, like I mentioned, in order to make money, again, on TikTok or really on any of these other social media platforms.
Michaela, you are a budgeting expert. That's one of the things that you are known for. Give the viewers some helpful budgeting tips for the holiday season.
Yeah, so we are right around the corner. One of my favorite things to do when I'm doing any sort of holiday shopping is to leverage cashback apps like Rakuten and Honey. These are very, very simple Google Chrome extensions and apps that you can download where when you're doing any of your online shopping, they'll notify you of cash back, and they'll also notify you of any coupons that are available. So you're earning some money back on purchases you're already making, and you're also hopefully getting a discount. The other tip that I have is to list out who you're buying for and specifically what you're buying. And that way you can be a little bit more targeted when you are shopping for gifts. But it also helps you avoid that last minute rush of, oh my gosh, I have to buy something. I'm just going to buy the first thing I see and I don't care how much it costs. The last tip I have here is to start getting creative with some of your gifts and also your gift wrapping. You don't have to go out and buy someone a super expensive gift. I actually prefer homemade gifts. And in my family, we do a lot of homemade gift giving, a lot of recycled wrapping, and it just helps keep the costs as low as possible for sharing gifts within your inner circle, and also being a lot more thoughtful about the gifts you're giving.
Michaela Alaka, thanks so much for taking the time here with us today. Appreciate it. Thanks. Coming up, everyone, how important is it to be happy at work? I talk to a business coach about that next on Wealth. A programming note. In this week's episode of Money Glow Up, Tiffany Alashay speaks to a financial journalist and behavior expert, Stacey Tisdale, about the best pathways to building wealth, real estate or the stock market.
Affluent blacks, those who have net worth of $700,000 or more, they put the majority of their assets in real estate compared to affluent whites. That's all that conditioning we were just talking about. Millennials, however, 70% of black millennials are invested in the stock market. It's a very generational. Baby boomers, not so much. Gen X, not so much. Millennials, 70% invested in the stock market. Black investors, the last 3 years in a row, have been the largest number of first-time investors to the stock market. That's because of technology.
Yes.
Technology really provided solutions that the government never figured out, financial services industry never figured out, by making accessible entry points with all of those, with micro investing.
You can catch the Money Glow Up every Thursday, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Well, return to office mandates have gained some steam this year. 80% of CEOs saying that they believe workers will be in person full time within the next 3 years. That's according to a KPMG survey. Our very own Carrie Hannon was on the show a few weeks ago to discuss the battle between employees and employers over return to office mandates. And you, our audience, had a lot to say on the subject. She received over 2,000 comments on her article. Back with us, we got Carrie with some more of that feedback. Carrie, what did you hear?
Well, hi, Brad. Yes, I mean, it was fantastic. There was so much engagement. Let's say, could we say it's a hot topic, return to the office? We had, thousands of people commenting. And the gist of it shouldn't be a surprise to most of us. It's that people are saying it's a complete time suck. You're not more productive in the office, and to ascend, if you think about it, they're right on many levels. There's that commute, there's the cost of gasoline or public transportation. It's really onerous in many situations. And so there was this whole sense of uproar over, that they're very productive and they need the flexibility. And in fact, and I agree with them, nobody wants to be micromanaged. And the real core issue here, Brad, is trust. They felt that their managers wanted them back in the office because they don't trust them. And that's a really tough thing. In terms of management, because that's something you really do need to foster between workers and their managers. So I think that's a big piece of it. To be fair, some companies do need people to be back in the office to kind of mingle and inspire, teamwork and stuff. But I mean, the question there is, does it have to be 5 days a week? So that's what I was hearing. But the funny thing, I got to tell you, I went back and just looked at the column I wrote this week looking at all these reader comments, and we've got over 3,000 comments on this column. So, I mean, it is not going away, this issue.
Look, I love the engagement. Sticking with the workplace trends, you recently wrote about older generations being happiest at work. What can you tell us about that?
Yes, indeed. This really warms my heart. Workers 65 and older, a Pew Research study came out that pointed to, it came out earlier this week, pointing to the fact that this is the happiest group of workers in the workplace, this older generation, that they feel very highly satisfied with their work. And in fact, there are a couple of reasons for that. They cite flexibility. They cite the fact that they feel respected at work and that they're not feeling left behind at all. That in fact, they feel as they're being offered the educational and the training that they might need to stay in these jobs. And so that's really a great sign. And the reason is this segment of the workplace has really been ticking up in recent years as workers are staying on the job longer than that traditional 65 retirement age for a couple of reasons, Brad. They're doing it because they need the financial security. They want that extra oomph. They're not ready to retire financially. And secondly, they love what they do. They really enjoy their jobs. And I must say, the group of people that say that they really enjoy their jobs and working is higher than the percentage that says they're only working because they need the money.
Carrie Hannon, thanks so much, and can't wait to see what more of this engagement on your stories looks like. Appreciate it, Carrie. Well, how important is it really to be happy at your job? Well, our next guest says it's more beneficial to find a position that supports your contentment in your overall life. Here to break down what that means and how to find the right job for you, we've got Amina Altai, who is a business and career coach. Great to have you here in studio with us. All right, so what is step one to really making sure that you are finding happiness, perhaps more so in the balance of your life, and finding a job as well that brings you that balance?
I think the first thing is really understanding the distinction between happiness and contentment.
Okay.
In the West, we're obsessed with happiness. But happiness is an emotion and is therefore fleeting. They're supposed to be changing all the time. So when we grip onto happiness as if it's supposed to be stable, that's where we get into trouble. And so contentment really in Eastern traditions is this prized state, and it's about unconditional wholeness. So we want to look for jobs that allow us to cultivate that contentment versus just the happiness, because our emotions are always going to be changing.
And so what are the decisions that somebody should be working through in order to make sure that the job is bringing them that contentment?
Some of the questions I invite my clients to ask are, what are the values of this organization? Are they aligned with my values? I also invite them to inquire about what people are doing to support employee mental health and well-being, because that's going to really support well-being and contentment, of course, as well. And then what are the organizations doing to support you in terms of growth and development? Because if we're not growing, oftentimes that stagnation does lead to friction and discontentment.
How do you go about kind of evaluating this early on in your career versus later on in your career? Because, I mean, life comes at you fast, and you really have to make sure that you're putting the right values in place while you're making even decisions like this about where to work.
I love this question because I believe our ambition goes in cycles. So there's moments where it's underground and we don't want to grow and we're just kind of stable, and then there's moments that we really want to be kind of reaching towards the sun. And so give yourself permission to evolve over time, check back in on those values because they're going to shift based on the season of life that you're in.
in.
And so with all of this in mind, there are a lot of people that are trying to make sure that the current job that they have is able to outlast inflation and is a salary that they feel comfortable with, making sure that helps them best combat what some of the normal services and goods are that they need to purchase into. How are you coaching people to navigate through that?
Well, first of all, if you can ask for a raise, I think it's a really great time to ask for more, especially for women and other historically excluded people. We tend to be paid a little bit less, so make sure you're checking in on the salary band. You can ask for a pay equity audit, something like that. But I also invite my clients to make the most of the money that they have. So use a tracking app, because you will ultimately find something that you were paying for that you had no idea that you were paying for. I'm also a big fan of the 12 traditions, and so in Under Earners Anonymous, they talk about how holding on to unused possessions actually is a sign of under-earning. So if you have unused possessions, get rid of them, turn them into cash, use them for something that you want to be spending time on or spending money on. And then the last thing I'll say is zoom out. So countless studies talk about how zooming out and kind of going to the last couple of years of our life and thinking about what will matter to us will help us make the most of the present. So in that last year of life, what's going to matter to you? Is it going to be your family? Is it going to be your health? Probably a few other things, and spend your money on those things.
Just lastly, while we have you here, there are a lot of people that are trying to make sure that they have either a side hustle or multiple streams of income.
Yes.
How do you go about orchestrating the buildup of an additive stream of income while you're also navigating through an existing job or even family life, whatever have you at that point in time?
Yes, well, when I'm helping people build a side hustle, we usually build it in their zone of genius. So that's the place where you are off the charts.
Zone of genius.
Your zone of genius.
That's the first time I've heard that.
Yeah, so actually the term was coined by Gay Hendricks in his book, The Big Leap, amazing book.
Okay.
But it's this space that you are off the charts, brilliant and amazing, and you don't have to push, force, or effort to contribute something out of this world in that space. So you don't have to put that much time into it. So that allows you to maximize the time that you do have for that side hustle and the return on investment.
Amina, thanks so much for taking the time here with us today in studio. Some great advice and career coaching tips everybody could use out there.
Thank you so much.
Certainly. Everyone, let's do a final check of the markets as we're nearing 12 noon Eastern time. It's almost lunchtime here. Dow Jones Industrial Average, you're seeing that down right now by about 0.2%. S&P 500 down by about 0.25%. And the Nasdaq Composite, the tech-heavy average, you're seeing that lower by about 0.4% right now. That's going to do it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.